Good morning, good morning, good morning, everyone. My name is Don Daniel, founder of PILL Method International, a better way to eliminate debt. And today we're going to have a special class today, a master class on insurance. And we have in our studio Mr. Perry Jeffries, who's muted right now. So Perry, why don't you just take yourself off mute right about now and tell the folks who you are and what you do, please.
Hey, what's going on, Mr. Daniel? Hey, pleasure to be here again with you, my friend. Always a pleasure. So my name is Perry Jeffries, president of Diamond Equity Advisors. We are a registered investment advisory firm located here in Central Ohio with clients across the nation. How we help clients, we help businesses as a fractional CFO, helping them drive their profitability, eliminate debt, just make the business more valuable and help them scale via systems and strategies. And we also help individuals accelerate their timeline to financial independence by introducing them to our wealth accelerator method that we deliver to them from a private client standpoint. So all in, we help people get to their financial goals. So whether they're a business owner or whether they're a 9-to-5er, we don't, you know what I'm saying, doesn't matter to us. Our goal is just to help you get to your financial destination. So that's what we do, man. So we can dive into a lot more of that if there's anything else you want me to kind of particularly to touch on, but that's how we rock and roll, man. We're here to help.
Listen, man, there's a lot we're going to be talking about today. Well, my name is Don Daniel, founder of PILL Method International, a better way to eliminate debt. And PILL stands for prepayment of principal, isolating the principal amount, leverage, and liquidity. I am your interest cancellation expert. And when it comes to interest cancellation, meaning this, you don't have to pay all of that interest on your loans, especially your mortgages, and pay off all of your debt in an average of 7 to 9 years. And if you're not, listen, you can level up your game by paying 75% less interest on your loans, 75% less, which means more of your money goes to where it was intended to go to pay off the loan. And when it does that, using your current budget, you can pay off all of your debt in about 7 years using the PILL method, using our technology, which is our AI cloud-based computing platform, the OCC opportunity cost calculator, and our superior financial education. And part of that financial education is bringing people like Perry Jeffries to the table, where he can talk about how to manage the funds that you have now. Listen, you all are working hard for your money. All right. You remember the song, Working Hard for the Money? Okay. You work hard for your money. Now, let me tell you something. We're going to be talking about this next week. All right. Next week, Friday. You don't want to miss this next week's Friday show because you work so hard for the money. We're going to be telling you the truth about your money even further. We're going to be talking about slavery by another name. Ooh. Slavery by another name. Let me tell you something about this right now. Okay. Just a little taste, and then we're going to jump in with you, Perry. Okay. So what we're going to be talking about there is how the United States financial foundation is based in slave labor, and how many people became wealthy, and that wealth is still manifesting itself today based on slave labor. And so we're going to also talk about how slaves were not allowed to learn how to read. It was against the law for them to understand their particular situation by learning how to read and understand what was going on. Because once you get that knowledge, now you're saying, oh, I'm in this situation. I don't want to be in this situation. How do I get out of this situation? And then you have revolts. Okay. And let me tell you, folks, there were a whole lot more slaves than there were slave owners. Okay. A whole lot more slaves than slave owners. So ignorance was their best tool. Ignorance was their best tool. Now, what is that like today? Lending today is modern day slavery. Because we're ignorant to how the banks make their money and how we borrow money. We're borrowing it in the worst way possible because we're following what they're saying. But if we turn it around, if we learn how to read an amortization schedule, if we learn how the money actually works, we can take the same system and turn it on its head, and you can become millionaires. Turn your loans into wealth by understanding what it's all about. You need to understand the basic principles of what slavery did to enhance wealth in America. And right now, since old time slavery is against the law, new time slavery is very much part of the law. And new time slavery is how lending is practiced today. You want to be here next Friday. So Perry, talk, man.
My goodness. That's going to be a powerful segment. Yeah, it's giving me chills down my spine over here.
Listen, man, we want to talk about insurance the right way. For a long time, I think people have been talking about insurance the wrong way. Can I tell you my story to start with?
Please.
Okay. My story about insurance is this, Perry. I started out when we were married, and I got insurance, because, that's what you do. You get insurance so that you can, replace that income if something should happen to you. All right. So I got 20-year level term. I didn't know anything about insurance. This is okay. Let me get the most insurance I can for the smallest amount I can for, make my monthly payments. And I did that for 20 years. You know what? I outlived my insurance. I lived longer than 20 years. And in the meantime, Perry, I am now a cancer survivor.
Wow.
And because I'm a cancer survivor, and now when my policy runs out, how do I get insurance? Because that insurance policy I had for 20 years, that was based on my current health situation. Now my health situation has changed.
Whew.
Now if I can get insurance, it is so sky high. It is crazy, or I can't get it at all. You know how many times I've been turned down?
Oh.
Turned down, can't get insurance for any price. And then when I can find somebody to get me insurance, the price is just ridiculous. So Perry, talk to us about this, about term insurance, about IULs, and about whole life, how we can use insurance to our benefit and let's help the people not be like me. Can you help us do that today?
You know what? I'm going to do my best. I don't know, Mr. Daniel, because, I kind of want to be like you, but I get it. So we're going to help them definitely navigate this space.
Okay.
So, man, first of all, thank you so much for starting with a story. I'm going to start with a story as well, but I'm going to give a historical account of some things here. And for those that want to fact check and things of that nature, please go online and kind of check some of this stuff out for yourself. But I want to kind of go back to what you mentioned earlier. You're going to have a segment where you're going to talk about, kind of slavery and the new age slavery that we're dealing with right now, but also too how, the principles and things practiced back in those times have created generational wealth for those individuals who enslaved our people, right? So let's dive into this a little bit, because I believe we always have to have a really good foundation and understanding history so that we can make better decisions moving forward. So here's the deal. First of all, kudos to you for even getting insurance, because there's some statistics out there. I won't be able to quote them at this time. You guys can check it out. But when it comes to Black folk and people of color, we have a high rate of people walking around with no insurance. Right? And so first of all, kudos to you for getting insurance. Right. But then we have folks who walk around without life insurance. And it's mind blowing to me. And it was a point in time in my career, I'll be like, man, that is the most irresponsible thing I've ever seen in my life. How dare you walk around without life insurance? But then I had to really, zoom out and understand why people didn't have life insurance,
Hmm.
especially such a high percentage of Black and brown folks. So I started to do a deep dive and really starting to understand why Black and brown folks in America do some of the things that they do. So what I started to unpack and dove into a documentary. I'll see if I can pull up the name of the documentary here online. The title is escaping me, but we were getting into Black wealth in America.
Yes.
So when we take a step back and really dive into this piece, let's get into the post-slavery era. Okay.
Hmm.
And in that post-slavery era, you had folk, who were recently emancipated, and they were trying to do the right thing. So they were doing the right things as far as trying to open up bank accounts and things of that nature. They were trying to do the right things as far as getting life insurance. So
Right.
without going through a whole, dissertation over the documentary, what it revealed to me was why people, first of all, fear or have anxiety talking to people in the financial service industry, why there's so much untrust, and also too, why folks believe that, life insurance is too expensive for them. So just a quick history lesson here. Good folks were emancipated, trying to do the right thing. Many of those folks became, sharecroppers and entrepreneurs, and they were trying to deposit monies into the banks, right? And the banks down south didn't want to rock with them. So the North of the Union, who had just, obviously won the Civil War, said, "Hey, we're going to open up this bank called Freeman's Bank, specifically for the recently free, African Americans." And folks, trying to do the right thing, like, hey, we got to put money into the bank. That's what we're, saying. That's what our counterparts are doing, and we want to make sure that we follow that same playbook. Well, fast forward, monies are flowing into the Freeman's Bank, and then a recession hits not too soon after, kind of the Reconstruction period, if you will. And Black and brown folks were going into the banks to try to get some of their money out, right? Unbeknownst to them, there was no money there. So the folks who were running the Freeman's Bank had actually stolen all of the money out of the banks, right?
What?
Yes, you look it up. They brought in Frederick Douglass to help fix and remedy the problem. When Frederick Douglass came in, he said, "There's no problem to remedy. There's no cash here." So literally, the chairman of the Freeman Bank stole all the money and distributed that money to his white peers. And the Black folks went in there and had none of their deposits were there.
Oh my gosh.
So what did that Black husband, who's trying to provide for his family, trying to do the right thing, what did he do when he went home and spoke to his wife and kids? Wife is there like, "Hey, did you get the money?" He's like, "We don't have any money in there." Hard-earned money that they have. They're trying to start a life for themselves, trying to live out the American dream. Their money's not there. Immediately, what is the mindset of the people? So that family.
Oh yeah,
Well,
you can't trust banks.
you can't trust the banks, right?
Listen, I had no idea that there are a lot of people I know that Black and brown that don't use banks.
Yeah.
All right, they use money orders.
Yep.
They're walking around town paying their bills with money orders.
Yep.
And I had no idea that this money trauma
Yep.
from the Freedmen's Bank
Yep.
flowed all the way up to modern times. I had no idea it was based in that.
This is the deal, man. The one thing that we do as Black and brown folks is we carry on traditions, right? It's 2024 and folks still making chitlins. You know what I'm saying? You know what I'm saying? Rest in heaven. You know what I'm saying? My mom rest in heaven. And we would only eat it once a year. My mom was from down south, and it's like,
okay,
so those traditions of recipes and whatnot have survived generations. So has that money trauma that you spoke of. So just bear with me here because I'm now about to go into the life insurance piece.
Okay.
So now we have a don't trust the banks. Don't put your money in the banks. They will steal your money. And banks, let's just say financial services, right? So now folks don't trust financial advisors, don't trust stock people, because bank and all of that all kind of ties into one. Don't trust, them folks in them suits at the bank, right?
Mm-hmm,
So
mm-hmm.
so it's a reason why folks have a, a positioning of like, oh man, can I trust you with my money? I don't know if I can trust you, right? Because that is that trauma that has been passed down from generation to generation. Now, during that same time of the Freedmen's Bank, you had, black and brown folks trying to go out and get life insurance, right? And there was an article written, because keep in mind, back then there wasn't social media, there wasn't news, what I'm saying? You had publications. And black and brown folks trying to go out here and get life insurance because, hey, I want to protect my family. If something happened to me, I want to make sure that the land is paid for and my wife and kids are good, right? Well, they were priced out of getting life insurance because this article that was published shared that, hey, black folks, because of the way their brains and skulls are built, have a higher chance of death. Right now, we know, historically speaking, a higher chance of death was the lynching and all the craziness that was going
Yes.
on during the Jim Crow era. But
Yes.
this article was published that said, hey, because of the physiology of the black and brown men and women, they have a higher chance of death, right? They die 2 or 3 times younger and faster than their white counterparts. Well, you probably like, saying, people listen like, but Perry, why is that important? Well, here's the deal. Let's understand how life insurance is priced. The cost of your life insurance, which you just mentioned, is priced upon, it's a risk play for the insurance company. The higher the risk, the higher the insurance.
Right.
So now if everybody has adopted with this article that was floating around that, black folks die early because of the way their heads are shaped and the way their brains are configured, and they're going to die earlier, that means that life insurance costs are higher, sometimes 10x for black folks during this time, because the white insurance policies, insurance carriers adopted it, which is so crazy. So now I'm trying to go get life insurance for my family, right? My white peers paying $10 a month, what I'm saying, for $100,000, and they're telling me, well, for you to get life insurance, it's going to be $100. I can't afford that. So now I go back to my wife. I'm already disgruntled with the banks and the financial system. Now I go back to my wife and say, I can't get life insurance because we can't afford it.
Oh my
So
God.
now we have distrust for the banking system. We have distrust for the insurance system, and also too with the life insurance for those who could, black and brown, who could get life insurance. Sometimes the death benefit wasn't paid out. We see this even with, if we go back and we look at Malcolm X's story, if you read Malcolm X's autobiography, his dad, who was a pastor, was murdered, was actually thrown on train tracks and lynched. And when the mom tried to go and get the insurance policy, I'm saying, not get the insurance policy, but get the death benefit, they're like, oh no, he committed suicide, so we're not going to pay you out. That man didn't commit suicide. He didn't throw himself on them train tracks, right? So again, now we have a distrust for life insurance.
So what I'm hearing is kids who grow up in those families.
Yep.
What are they hearing? Life insurance, no good.
No
banking,
good.
They're evil. They'll steal your money. Don't put your money in banks. So this is what the kids are learning.
Yep.
And then they're passing it on to their children.
Yep.
And listen, 1863 to 1963 listen, that's just a few generations. So we're wondering, why are we so behind the 8 ball, so behind the curve in financial acumen, learning how finances actually work, when there's just a few generations from slavery to today, and we're getting this kind of financial information from our families.
Yep. Check it out, Mr. Daniel. My grandfather, and I know this isn't everybody's situation, my grandfather was born in 1868, who I'm named after. I'm Perry Jeffries III. Perry Jeffrey was born in 1868, had my dad in 1948. So we had my dad when he was 80, right? So you talk about, one, two, we're talking what, 3 generations, 2.5, 3 generations, right? So it's a reason. So when I start to kind of zoom back, because I was, so frustrated, like, man, why are we not investing? Why are we not getting life insurance? When you start to unpack that trauma, understand it's been passed down for generations. Like, I've been in this industry now, Mr. Daniel. We're going to get into this life insurance piece. I've been in my industry now 20 years, right? I became a Series 7 stockbroker in 2004. So one of, and at that point in time, Black folks made up less than 1% of the security registered folks across the country, right? I got my life insurance in 2004. So my life insurance license. So I've been in this space on the life insurance and, let's say, the banking and investment side now for 20 years. And when I started to get this realization, like, oh my gosh, the reason there's such a huge wealth gap is there's a crazy trust gap and a crazy information and knowledge gap that we got to make sure that we get in front of, right? So thank you for doing what you're doing with this whole piece. I wrote down something that you said in here. It was, we got access to the strategy and the AI and all that technology, but the superior financial education, that's the key, man. We need to understand why we think this way.
Right.
I've never had, because I have, Black and white clients, you know what I'm saying? My wife is Jewish, right? So I have Black clients, white clients, Hispanic clients, old, young. I've never had a white client ask me, hey, Perry, can I trust you with my money? Or is this a scam? I'm only ever asked that question by my Black clients.
Wow.
Only.
And listen,
and I've been doing this 20 years. So I got one hell of a case study. So can't too many people tell me about that. Not too many people have lasted in this industry the two decades the way I have, right? So
and we wonder
that question.
And we wonder where that comes from. And now you telling this story helps people to understand that it's all based in lies.
Yeah.
It's all based in lies.
Yeah.
So Perry, what do we do? Once we understand that our financial situation, the way that we look at lending, the way that we look at banks, the way that we look at insurance, is all based on false information to keep us from passing on generational wealth. Listen, my father passed on nothing to me. His father passed on nothing to him. His father passed on nothing to him. We keep starting at zero each generation because we have been fed a bunch of lies about finances. Perry, what do we do? What do we do?
You know what? Well, one, tap into things like this, right? Get this education. And you have to be, and I'm used the word here, obsessed. This is 2024. I made this my Mamba year. Shout out to Kobe Bryant. And one of the reasons Kobe Bryant was so successful and such a high achiever is because he was obsessed with the getting better. So if you really love your family and you understand that, second and third to your faith and your family, your finances is probably the next most important thing on the list, right? Because you need that to be able to provide and put a roof over your head and feed yourself. You have to start to become obsessed with getting this information, right? Doing research, asking questions, getting in the right rooms, hiring coaches the way I hired you a couple years ago, getting inside to Accelerate Academy that we offer, where we help people, navigate their finances and get on the right path and unlearn some of the things that, that's part of their current money story. So yeah, man. So that's what it's about. So, and let's get into this life insurance, but I wanted to give that backstory just so we can understand why so many folks, why even our listeners right now maybe have this hesitation with life insurance. Let's start to really understand why. But let's unpack it, man. So let's talk about this wealth piece. We talk about generational wealth. One of the fastest ways to create some generational wealth. And when I say generational wealth, because I almost got to the point where I hate the term because everybody uses it.
Right.
But we're going to talk about two ways to create two ways today to create generational wealth. One is to pass on good information. That's the first way to create generational wealth.
Okay.
Is the information share. The second way you can create some generational wealth pretty inexpensively is life insurance, right? We hear the story about the Rockefellers, how they created their own bank using life insurance and trust accounts, right? And we can maybe get into that, but let's start off and get some base level, and then we're going to build from that piece, right?
Right.
So let's talk about term life insurance is what you had. So you had a 20-year term.
Yes.
So let's dispel this, let's put an end to this debate of which is better, term or permanent.
Okay.
You hear the people say, hey, buy term and invest the rest.
Yeah.
And you hear people saying, hey, no, you need to get permanent insurance. Term is a waste of money. Here's the deal. Stop comparing these two. They don't serve the same purpose. All right. It's like comparing, a spoon to a fork. If you eating soup, get you a spoon. I hope you're not eating your soup with a fork.
Okay.
If you eating steak, get you a fork and a knife. That's how different these two are. So let's stop comparing them. Okay. There's not one is better or worse. They serve two different purposes. So let's level set. Term life insurance is just that. It is an inexpensive life insurance policy for a term of time. The reason it's called term. In your case, sharing your story, we'll use that as the case study. You had a 20-year level term. So what does that mean, everybody, in layman's terms? And financial literacy is super important too. So I'm going to make sure you guys get this language down. But term, that level term just simply means that Mr. Daniel had a insurance policy that was based upon his age, his sex, and his current health at the time. He got, I don't know if he got 100,000 or a million, but it was at a fixed amount per month or annually, however he was paying for it, right? And the term was, hey, you have a term of 20 years. The same way a lot of us got 30-year mortgages. You pay that mortgage for 30 years. You pay this term for 20 years is what he had. And at the end of that, now, if you want to keep that, the price may 100x for you to keep that and just be impossible to keep, or it may actually collapse. So some may say, well, Perry, why would I want that term? Well, that's how you get your highest death benefit. Before me and my wife got married, I wrote $1 million term, 20-year term on her for $47 a month.
Wow.
$47 a month would pay us $1 million if she was to pass away in 20 years. Right? I also took out another life insurance policy on myself, I think for another $500,000 to protect her. So here's the deal. We have term policies and we also have permanent policies, but we're going to get to the permanent here in a second.
Okay.
Now, those term policies, right? They're inexpensive. And we highly recommend them because you know what? You may not be in a position to put a big chunk of money into a whole life policy, or because those policies are going to be a little bit more expensive. But we're going to get into dispelling some of the lies being told on that. But we like term for a death benefit. When I purchased the home that I'm sitting in right now, this was a $900,000 home, Mr. Daniel.
Okay.
What did I have in place before my first mortgage payment was due? I went out and got another term policy. It was for $85, 750,000, right? And Perry, you say, hey, Perry, but why did you do that? Because if something happens to me, I want my family to be able to pay this house off in full. So if something happens to me before my PILL method time, I'm saying my 9-10 years before I pay the home off because I'm using the PILL method, if something were to happen to me, now they can take, hey, this particular policy is to pay the home off if something should happen to me, because I don't want to leave them with a $6,000 a month payment and I'm the main breadwinner.
Right.
So I have 3 term policies. I got a policy before when my daughters were born. I got a term policy when I got married, and I got another term policy when I purchased my home because I wanted to leave something for my daughters. And when I got married, I want to leave income for my wife. And if something should happen to me, I want the home to be paid off. So if we get off this call today and the Lord calls me home after this call, this house is free and clear.
Okay.
So again, it's a tool. It's the spoon for the soup. A permanent policy would not be a good fit for that because I have a couple $1 million on me now, and to do that in a permanent policy would have cost me a couple $1,000s a month, where now it's barely $200 a month, right?
Perry, I just put a link to this show in the chat. And if anybody wants to come in on the stage and ask their questions, are you willing to answer some questions if we can get people, encourage them to come into the stage?
I'd rather sit here and answer questions than just go on a rant.
Okay.
I much rather
right.
answer questions.
So you see it, folks. The link is in the chat. So go. This is our StreamYard link. It will bring you into the StreamYard studio, or you can put your questions in the comment section. All right. So we're getting more and more people coming in, Perry. They're loving the conversation. Keep it up. Excuse me for interrupting, but I wanted to let them know that they can come into the studio and ask their questions live. You can stay on video. You can be on video, or you can just be on audio. You don't have to have your camera on, but come into the studio and ask your questions. Go ahead, Perry.
Oh yeah, absolutely, man. And definitely please come in, because if you're taking the time to listen to this, I would love to make sure that we give you some value that's very specific to your situation. So please ask those questions and come in, right? So now, kind of picking the story back up, I have several term policies. And there's different kinds of term. My first policy was a return to premium term policy. So at the age of 75, if I haven't passed by that time, I get all the premiums back that I paid into it, right? So I have a return to premium. I have a level term, right, for when I got for my wife, and I got another term to pay off the house, right? But here's where, and let's go back to your case study here. And a lot of folks don't realize they should do this. All of the term policies we have, Mr. Daniel, the last two that we picked up, are all convertible. And you may be like, well, Perry, what do you mean convertible?
Well, you know, I'm going to ask that. Convertible.
Okay, there you go. You know what I'm saying? I'm glad we both asked the question, right?
Okay.
Convertible term. And this is how I always advise my clients. Hey, we're going to get term right now because we can purchase a lot of death benefit for a small amount of money. But we want this term to be convertible. Well, Perry, what do you mean convertible? That means that anytime in the future, depending on the insurance carrier, right? Sometime in the future, some say, hey, you can just, do this and for the next 20, 30 years, but whatever the case may be, we don't get into the weeds that much because we could. But the convertible term means that it can be converted into a whole life permanent policy. Listen to this, without having a physical, right? So let's go back to your case study. I'm so glad you shared that story.
Without having a physical?
Yes, sir. That's why it's called convertible.
Come on, man. Listen, folks. Listen, folks. You all ought to be putting some fire emojis, some hand claps in the chat or something. Listen, this stuff you have to pay for. Come on, Perry, break it down for us.
Yes. So here's the deal. Yes, I bought term because I wanted a large death benefit for a small amount of money, but it's convertible term, which means the agreement that I have with my insurance carrier is that if sometime in the future, 5, 10, 15, 20 years down the line, I'm like, hey, I want to convert a part of this $1 million policy into permanent insurance, right? So permanent insurance means insurance. It's called permanent for a reason, doesn't go away. And so permanent insurance / cash value insurance, kind of synonymous. Okay. So I could go and convert some of the term into whole life permanent insurance without having to get a physical. So going back to that situation that you had, Mr. Daniel, if the agent had said to your educated, you're like, hey, let's get this term, but you know what? Your health changes, right? You had cancer at sounds like a relatively young age, right? So the deal is, regardless if you had the cancer, you could have converted part of that term into a permanent policy without having to get a physical. We are literally in the process of doing that right now with a portion of my wife's term. So that same $1 million term that I purchased on her for $47, because of where our income is, we can no longer contribute to a Roth IRA, nor do we desire to. So now we're going to convert part of her term into whole life, where we're still funding it the same way we would fund a Roth IRA. And now what we're doing is creating, and this is going to be a great segue until we get into this whole life piece, we're creating what they call the rich man's Roth. hey, for those folks who got technology and got access to Google, you know what I'm saying? Google rich man's Roth. And what's going to come up is a strategy that says, hey, at some point in time, you may make too much income to contribute to a Roth IRA, but you still want a tax-free retirement vehicle, a vehicle that's going to give you tax-free income in the future. So you know where wealthy folks go? Because if they're wealthy and they're making a lot of income, they're already priced out of where they can contribute to a Roth. They start to use cash value insurance policies. Oh, don't get me started today. So we're converting some of my wife's term. We're going to keep some of it. We got 1 million. Got my illustration, and I think we're converting about 150,000 or so over to whole life, where that payment on that is going to be about $500 a month, $6,000 a year. And now she has a different vehicle. Remember, we talked about a spoon versus a fork. We took the spoon and said, hey, spoon, you're serving your purpose because we eating soup, but now we need a fork. Well, guess what? I can just convert that spoon into a fork. It's a spork. I didn't even know I was going to say that today.
Oh,
It's a spork.
listen, man.
Hold on, we got a whole new term now, baby.
Oh man, listen, I had no idea. I didn't have listen. I did some research, and I forget how I got the information. Whether I put it on the internet or I used my computer, but I didn't buy mine through a quote unquote agent who informed me.
Correct.
I put out like a wide net.
Yep.
And I think what I did was what I did was I put my name into somebody that was generating leads for other insurance companies.
Yeah.
And that's probably what I did. I put it in there, and then that way I got to look at several companies, but nobody educated me. I said, I want 20-year level term. They said, I said, I want some insurance. They said, okay, we got this 20-year level term. And listen, when you're young, you don't know, and you're young and dumb, you don't know anything. And 20 years seems like a long time.
Yeah, for sure. You like, and the deal is you were doing the right thing. So that's why I said kudos to you. So anybody listening to this, right? You're like, oh my gosh, I'm looking at my insurance policy now. It's not convertible, right? Please, first of all, kudos to you for you even getting life insurance.
Right.
And when you know better, you do better, right? So I'm glad you got this pulled up here for us here, Mr. Daniel. So now we've converted part of wife's term, right? 20-year term into a cash value policy to use as a retirement vehicle. So let's go back to what we talked about here earlier, right? We said you got a spoon and you got a fork. Stop having these crazy debates about which one is better. They don't serve the same purpose, right? So when we look at cash value or permanent insurance, we look at that as an asset. And there's going to be some people that be like, oh no, it's not an asset. People are lying. Life insurance, just life insurance. Where here's the deal. Two things I want to make sure we address here. Life insurance should be customized for your goals. Okay. And when I say customized for your goals, Mr. Daniel, well, this is what I mean, right? Let's go over here a little bit. What I mean is this. Yes, if you jump online and say, hey, I'm going to get some life insurance, right? Yep, there's going to be, hundreds of different companies. Yep, we can write an insurance policy for you. So what you're unfortunately doing is you're buying off the rack. That person didn't ask you, hey, do you have any, health history on your family? Is there any cancer or what's calling on your family? Right? They're not. Hey, what is this? What are you getting this for? I just had a client send over a proposal to me and said, hey, Perry, this is what my life insurance person quoted me. Can you take a look at this? And I said, well, I can't take a look at this because I don't know the context nor the backstory that you requested this life insurance, because life insurance is not a commodity, right? It should be a custom fit suit. It should be a conversation, a very detailed conversation as to what is the purpose of this policy today and what will be the purpose of this policy in the short future, the midterm, and the long-term future. So again, using that case study that you gave us at the very beginning, Mr. Daniel, if the insurance person had been, a planner, a advisor versus an insurance salesman, Let's make sure we get that down, y'all. It's the difference between a salesman, a salesperson, a saleswoman versus a advisor. Had you been advised on insurance, and had I been sitting down talking to you and I'm like, okay, what is this insurance for today? Hey, recently got married, want to have some terms, something happened to me, great. So we want to be able to, replace your income when you pass. Okay, amazing. But this is in 20 years. We may not qualify for the same type of insurance in 20 years. So what would be the plan? How do you plan to cover that? So you live 20 years. How do you plan to now have that same benefit in place? Well, I haven't thought about that, Perry. Okay, let's do a convertible term so we can convert some of this, as our income increases and we can afford it, right? So again, y'all, it's so important, so important that we are having the right conversations, right? And getting good sound advice. So now let's go into permanent, right? Because we've kind of opened up the door for that now. Now let's talk about the permanent insurance, the cash value. There are as many different terms out there. There's term 10, term 20, return of premium, right? There's so many other different kinds of permanent insurance, right? You got standard whole life. You got whole life 10 pay, 20 pays, pay to 65. You got, IULs, index universal lives. You got variable lives. You got variable universal life. We could spend a whole month breaking this down, but I'm going to give you guys some cheat codes on some of the stuff so you can understand. When you hear permanent policy, you're thinking cash value. So different from term, when you put money into this policy, a portion of that policy is going to pay for, some death benefit, and a portion of that policy is going to pay, was actually going to go into a bucket of cash as a savings vehicle. Okay.
Okay.
So let's just level set there. And Mr. Daniel, jump in and ask any questions as we go along with this. Okay.
All right. Well, right now I'm telling folks how to get a hold of you. I put a link in the chat. Folks, he's talking about how to get, an advisor. And listen, we didn't come on this show. We came on this show for educational purposes only. All right. We want you to be educated. And because we want you to be educated, we didn't come with the purpose of selling you insurance. We came with the purpose of educating you. But just in case you want to get a hold of Perry and get some of this knowledge firsthand, he has consented, because of this show, to do some advising or not a referral. What's the term? Consulting fee. Okay. He's not going to charge a consulting fee. All right. So if you want to consult with him, I put his link in the chat. All right. And then click on that link and you can get access to his calendar and set up an appointment, and you can consult for free. Come on, everybody. You can't listen. Some of these people are going to have to go before we end the show, Perry. So I just wanted to get that out there. So go ahead and now talk about this type of permanent. Break it down for us. Permanent insurance. Or you're muted again.
I had to adjust my desk over here. This light behind me was killing me.
I got you.
So with respects to permanent, so again, we want to give you guys some concepts, because again, we could get into the weeds in here very, very heavy. So when you think permanent, this is the deal. You're making a payment into this policy. Your monies are going to two places. One, to cover the cost of the actual insurance, and then two, to go into a bucket of some type of savings vehicle. Hence why you hear people say permanent insurance is cash value. Okay. Now, understand this. This does come at a fee. but there are no free lunches. So just understand. So I hear, the talking heads, oh, don't get this type of policy because of all the fees. Don't do this because of all the fees. Well, Mr. Daniel is breaking down for you, like all the fees you're paying fees everywhere you go. And a lot of us are overpaying fees or overpaying interest on our mortgages. That's why we're here to get smarter. So please understand, there is a fee to play. This is not, ain't nobody giving you nothing for free. So let's just level set on that piece. But that is how that is broken up. So money goes in, some money is going towards the cost of the insurance, some money is going into a cash, savings vehicle, hence cash value. Now, you have a bunch of different kinds of permanent insurance. The first one we're going to talk about is your plain vanilla, just whole life. It is fixed. This is what it is. You have a fixed amount of money that you're required to put into this product, right? This is kind of how I'm setting my wife up with her convertible term that she has, is that we're converting that to a plain vanilla whole life. Okay. Money is going in a fixed amount, $500 a month. The money goes in, is paying for some insurance. But the reason we like it is that the majority of those monies are going towards a cash savings vehicle. Now, with a plain vanilla whole life, how the money is growing is that money is earning dividends. Okay. And not dividends the way you would think about it from a stock dividend play. But when you're working with, a whole life, especially if you're working with a mutual company and you say, well, Perry, when you say mutual company, what do you mean? Because you hear the mutual in their name. It says ... mutual. What they're doing is they're paying a dividend based on how profitable the insurance company is. Every year they issue a dividend. So it's an annual dividend that they issue. One of the companies that I deal with is, I think if we look them up here, have been issuing a dividend of between 5 and 6% for like the past 100+ years. So that money, that cash value, is earning a dividend, I'm saying, annual dividend. So money is going into that account, that savings vehicle. It's earning a dividend, some interest from the dividend. So that money is growing, right? And I still have insurance in place. And again, we could get into the weeds. There's there's 10 pays, 20 pays, 65 pays. Whenever you guys hear that, it's just simply saying, hey, that particular product, you only have to pay for 20 years. Well, Perry, that sounds like term. So would I lose my insurance? No, you don't lose your insurance. It's saying a 10 pay on that whole life because now you have enough cash value in there to cover the cost of the insurance. So the cash value and the interest earned on that bucket is covering the insurance. So you don't have to pay that insurance anymore, right?
Wait a minute. Come on, Perry.
Go ahead now.
Are you telling me there's insurance out there you could get that will actually earn enough money to pay for itself?
Yeah.
Nobody told me that.
Yeah.
Nobody told me that, man.
Absolutely. Right. So that's just your plain whole life. And again, I could do a whole dissertation on that because you have whole life 10 pay, 20 pay, 65 pay. And you may be saying, well, Perry, well, which is the right pay for me? That's why you have to sit down and have a holistic plan, because I don't know which is the right one for you, because everybody's situation is different. Stop just buying insurance online and be like, I got insurance, because you don't even know what's going on with it, right? So that's on that. So that's the whole life plain vanilla. Let's fast forward.
Well, that's the whole life plain vanilla. But listen, there's a guy out there. He's
on that whole life. And if you guys are writing notes to your whole life, just put whole life equals fixed.
Okay.
Fixed amount you got to put in, and you're going to earn some type of dividend or interest, right?
All right. Well, there's a guy that's north of me in Nashville, Tennessee, saying whole life insurance is a scam. Don't buy it.
Okay, cool. I love that. Right.
Yeah. That's Mr. Dave Ramsey. He says, don't touch that.
So let's address that real quick. And again, I want to get into that piece real quick. When you hear that whole life insurance is a scam, the next research task I want you to do is go research what tier 1 bank capital is. Tier 1 bank capital. Well, Perry, what are you talking about tier 1 bank capital? So here's the deal. all of the banking institutions that we, put our money into and, to save and, have access to our funds on our debit cards and get our mortgages with and whatnot, right? These banking institutions are required to have what's called tier one capital. They have to have their money sitting in a place of, of where it's safe and still have some liquidity. And that shows you how solvent a bank is. So all the monies that we're putting in, they're not lending all of that out. They have their coffers, their war chests, which they're required to have what you call tier one capital. When you start to lift up the hood of the tier one capital, watch out here, Mr. Daniel. You know where a lot of that tier one capital is sitting?
No, where is the city?
Cash value insurance policies.
What?
So the banks have cash value. So when somebody is yelling that whole life is a scam, well, why are the banks? But so the banks ain't telling you any of this. The banks are telling you to, hey, you need to, get this CD. The bank is saying, hey, you need to, get this money market account. Hey, hey, the bank is saying like, hey, let us lend you some money. But they're not telling you, they're like, hey, but behind our closed doors, our tier one capital, which we cannot lose, a large percentage of that is sitting in cash value insurance policies. And let me tell you why it's sitting in cash value insurance policies. I just did a training on this inside our Facebook community last week. They're sitting there because one, you get tax deferment. So while it's sitting in that policy, that whole life policy, the same one that you can get, ladies and gentlemen, while it's sitting in that policy, is getting tax deferment. So you're not paying any taxes on the interest that it's earning, right? So you have the death benefit because they're linking these to the executives of the bank. Because if this person passes away, we need to replace them, which is going to cost $2, $3, $4, $5, $10 million or whatever the case may be. So they still had a death benefit. And lo and behold, we didn't even got into this feature yet. But this is the reason people, a savvy individuals start to really understand the flow of money is they still have access to capital, because if they have, $1 million in the cash value portion of the whole life policy, Mr. Daniel, they can borrow that and pull that out as a policy loan. Is not tax deduct. It's not a tax. It doesn't generate any taxes. It's not tax. You don't get taxed on loans, ladies and gentlemen. And they can then use that money to build the infrastructure of the bank while the $1 million in the cash value is still earning interest.
Wait a minute. Oh, wait a minute. Wait a minute. Wait a second. You saying I've got money in the life insurance, cash value life insurance. All right. And then are you saying I could, did I hear you can say I could borrow against that?
You can borrow against that.
And so I'm not borrowing the money I have in there.
No.
I'm borrowing the company's money.
You have now created leverage. That, your cash value is the collateral that the insurance company be like, yeah, we'll give you a loan. No, you ain't got to complete. No, we don't need to run a credit check. We don't need to know your my FICO. We don't need to know your debt utilization. Yeah, of course we give you a loan. We got the collateral sitting with us. So yes, here's your, hey, yes, send this paperwork. Let us know where to send the money to. Boom, and they'll send you the loan. Yep.
Wow.
And now the deal is, this is where it gets into the weeds a little bit.
Okay.
It has to be set up the right way, because you want what's called a non-recognition loan. So that non-recognition loan is, hey, my money is still in here earning the interest, and I use that as collateral, and then the insurance company sent me some of their money, right? So that's what the banks are doing. So who says that you can't do what the banks are doing? You can. You absolutely can. So when I hear people say, oh my God, whole life is a scam. And hold on. And let's have a moment of transparency here, Mr. Daniel.
Okay.
When I came into the industry 20 years ago, right? I came in as a stockbroker, right? I didn't come in as a financial planner. I came in as a stockbroker. Okay. So when I came in as a stockbroker, right? Our deal was, yes, stay away from that whole life garbage. Only, let's get you some term and we're going to invest the rest, right?
Mm-hmm.
Because that's what I was trained to say. That was the Kool-Aid that they gave me to drink. And then eventually I start making the Kool-Aid myself, right? So here's the deal. When you know better, you do better. So versus listening to what the banks are telling you to do, See what the banks are actually doing with their money. When you start to pay attention what the banks are doing with their money, it will blow your mind, right?
Wow.
So yeah, so look it up, y'all. You know what I'm saying? It will blow your mind. Okay, cool. Appreciate you bringing it up there. Yeah. So when I first was exposed to it, man, I got into the weeds in this bad boy. And I was like, wow, this is actually a real thing. The banks are actually using cash. So when Dave Ramsey's and the Susie Ormans is like, hey, don't, whole life is a scam, whole life is a scam. Well, I got a question for you. Why are the financial institutions that are propping the country up running this play if it's a scam, right?
Listen, and I say the same thing. I said, listen, people are trying to tell my clients all the time that borrowing money is bad. Borrowing money is bad. I said, if borrowing money was bad, then why are the biggest borrowers in town your bank? They borrow your money and then they invest your money and make a whole lot of money with your money and then pay you pennies on the dollar for the use of your money.
Oh, do you see? Now you're gonna start stuff. So here's the deal. Make sure you need to. I'm gonna hold you to this one, Mr. Daniel, because you brought it up. So I got to go there with it. But please, let's make sure that we come back because I'm gonna give the listeners some basic terms to understand so that they can start to navigate this insurance space, right? But yes. I gotta lean into what you just said right here. The idea that borrowing is bad. So inside our Accelerator Academy, I teach our members my Wealth Accelerator method. We call it WHAM. And the one of the pillars in there is really starting to understand leverage, Mr. Daniel. So it's so important that we start to understand leverage. So you brought that up. I would ask my members in the community, right? Hey, who's one of the largest companies that you know, right? They'll say Amazon, Google. When you go Google how much debt Amazon has, let me pull it right now. How much debt does Amazon have? Amazon, according to this, right, as of December 2023, has $135 billion worth of debt. Why would one of the largest, most successful companies of our time have that much debt? Because they understand leverage and they understand arbitrage. The exact same thing I have pulled up right there, my friend. So
wow.
They're like, why would we spend our money when the bank will lend us money based upon our cash flows and our assets, and we can then use the bank's money to go buy the real estate and build this plant and hire these people and get these trucks and all of the things? Why would I use my money when I have an asset that I built and their asset is their business, which a bank would be happy to lend to because of the cash flow? So understand, y'all, this is a play. This is how you accelerate your wealth when you start to understand the money. Because guess what they're doing now? They still have monies. They're not in debt because they don't have any cash. They're, you know what I'm saying? They have debt because they're like, hey, I'm gonna keep my cash working for me over here. So they're making money in their left hand, and then I'm gonna borrow the bank's money and then use that money to go make money in the right hand. So they're making money 2x of what we're doing because they're using the power of leverage, which it kind of goes back to this conversation we're having right now. Understanding that policy, that cash value policy, now gives you access to capital. You know, the one thing that's stopping folks from becoming financially independent is access to cash. If a deal comes up, an opportunity comes up, they don't have no money to use because they're like, man, I got my $10,000 in the bank. I want to jump on this, but shoot, if I lose it, man, shit, I lost that whole 10,000, right?
Yeah, that's
but
right.
If that 10,000 was in a vehicle that you could borrow against, and that 10,000 was still earning interest, and then you borrow somebody else's money at say 5%, you borrowed the insurance company's money at 5%, then now you can invest in this opportunity, and as long as it makes more than 5%, you have positive arbitrage, right? You borrowed the money at 5 to go do something that made 15, 20, but your principal is still making money in the account.
Wait a minute.
Oh my gosh.
When I start to pay that money back, okay, I pay the money back at 5%.
Yeah.
So I'm paying 5% interest on the money that I borrow.
Yes.
What happens to that interest money I just paid to pay
Right.
that back?
Right. So that goes back to the loan, right?
Okay.
That goes back into the loan, right?
Right.
So because now you become your own bank, you want to be a good borrower. If you borrow money out, you want to pay that back, you know what I'm saying? Pay that back. So,
Right.
the insurance company, they're gonna get their interest. And that's fine. That's totally fine, right?
Okay.
Now, here's the deal. And again, this gets into the weeds a little bit. You're not actually required to make the loan payment.
Oh,
Stay with me here.
what?
Stay with me here. Stay with me here. You borrowed the money, and
Yes.
let's say that you're a irresponsible borrower. You know what I'm saying? You don't pay your stuff back. You ain't even paying yourself back.
Okay.
Let's say that because I always like to play worst case scenario. Well, Perry, man, I hate debt, and I don't want to get in trouble. And if I don't pay this loan back that I took out of my policy, are they coming for me? Is it going to affect my credit? No, right? But
No.
what end up happening is if you borrowed 20,000 out and your insurance was for 100,000, your death benefit would typically be reduced by the amount of that loan. So instead of 100,000 being paid out on your death benefit, 80,000 would be paid out. Right.
Wow.
So,
Wow.
but the deal is you still want to be in a habit of paying that loan back because you still want to get access to that capital again.
Yes.
Right?
Yes.
Yes.
I got a question. We got a question that just came in from Valerie.
Oh, let's talk, Valerie.
All right. There she is, Valerie Robinson. Okay. She was talking about the loan, the non-recognition loan. What what do the banks use? What's the kind of policy that they use?
Yeah. So you'll see a lot of them use index. You'll see them use IULs, but you can also have that same type of situation on the whole life policy as well, right? So that non-recognition loan is not exclusive to the IUL, which is short for Index Universal Life, right? So you'll see that on kind of all option. Hopefully, that's an option on anything that you're looking at. Okay.
So let's make this abundantly clear, Perry. So what you're saying here is, if I'm understanding you correctly, there's no one answer
No.
to that question.
No.
That this is the thing to do.
Correct.
What you need to do is look at your situation, the unique qualities of your particular situation that will dictate what type of policy you need.
Absolutely.
As an individual, you could get some sort of IUL where your neighbor in the same neighborhood, they would get some sort of whole life policy to meet their need with a twist and add some what do you call that
what you got
term with it.
Yep, for sure.
Do some combination type stuff.
It's a combination. So check this out. Great conversation here. Let's keep this going. So she brought up IUL, and somebody may be looking at like, well, Perry, I don't know what an IUL is. Let me give some terms out here, and then I want to make sure that we can level set because we're going to talk about a lot. Okay. We're going to bounce around, and questions are going to come in. But I'm going to just give some terms here to make sure people got it. Term is actual term. So the years, how long I have this for this amount of years. Term. Whole life equals fixed. Okay. When you start use terms like IUL, that's short for indexed universal life. What does that mean? Indexed. Index is just referring to how the dollars can be invested. So it's going to be invested in something that feels like, the S&P 500, for example. Okay. Now, it's not actually invested in the market, but it's invested in options and things of that nature that's actually going to look and feel like the stock market, the S&P 500, for example.
Okay.
When you hear the word universal, ladies and gentlemen, just think universal equals flexibility. With the whole life, you're required to put this amount in. If it's $500 a month or $1,000 a month or $100 a month, it is fixed. That's your requirement. You have to put that in. With a universal, you have more flexibility. So universal equals flexibility. So you can put in a 500, but then if you have like a down month, it's like, man, I can only put in 100. Let me put in 100, but I have an up month. Okay, let me put back in and put in 1,000. So you're still going to kind of have a cap on how much you can put in, but based on your cash flow, you have some flexibility on how you can put money in, right?
Okay. So well, listen, we got some other questions in here.
Go ahead.
And I think I know where they're going. So I'm going to ask the question this way. I'm going to ask the question this way. An IUL, okay, loosely based on term insurance, correct? Okay. So here's the downside that some people have for IULs. After a while, the cash value is eaten up because the term insurance gets too expensive and will eat up all of your gains. Can you talk about that for a minute?
So here's the deal. When we say eat up all the games, I want us to kind of think about it like this water. Let's go with this water bottle that we have right here, right?
Right.
So you got premiums going into the water bottle, right? So that's money that's going in, that's growing the cash value. Also, what's going into the water bottle is you're going to have, the indice, the index that you're invested in. So let's say S&P 500.
Right.
So that is how that's how water is going into the water bottle. How is money coming out of the water bottle? You have water that's coming out the water bottle in insurance fees, mortality costs, things of that nature, right? Depending on your insurance agent, how they build it, because you brought up something earlier. You could have an IUL and somebody could have a whole life. Let me give you something else. We could both have the same IUL with the same name and not have the same product.
What?
Because you can customize an IUL to fit a certain need, right?
Okay.
So just put that in mind, y'all. So we could sit and say, hey, we both have the same IUL from the same company with the same, product name, and our products function very differently from each other. Okay, now let's go back into this fee piece.
All right, so I've got some folks here. I want to tell them I usually don't keep the audio on Clubhouse, but I did this time.
Okay,
we're only taking questions on YouTube.
Yeah.
So if you want to come in, we've got the link there. I'll put the link back into the chat. If you want to come on stage or whatever on YouTube, please do. But we're not taking any questions on Clubhouse.
All right, cool.
Go ahead.
So money's coming in with premiums and then the growth. Money is going out. So what's going to come out of this water bottle is going to be the fees for the insurance. If you take out a policy loan, things of that nature, right? So here's the deal. Where we see the policy get eaten up, and this is one of the reasons, like back in the day, I was anti-IUL, and in full transparency, I have an IUL, right? But back in the day, I was anti-IUL because I would see these policies and be like, oh my gosh, this is really hurting the client. They're like, oh my gosh, Perry, I got to put more money into this thing to keep it afloat, . And I'm like, wow, I hate these policies. But what the reality was, Mr. Daniel, is these people had took loans out, never paid them back. So what was eating up the cash value was, yes, the cost of the insurance, but also the fact that they never paid their loan. So they're losing that 5-6% on the loan in addition to the fees. And that's what was eating up the cash value. So have to understand this, y'all. You have some policies that's going to require you to be an active participant in the policy. With a term life, you sign up, you ain't got nothing to do so for just make the payment. When you start to get into these whole life policies and you start to try to pull money out, you have to still be responsible. You can't be messy and not pay your loan back. So for all of those policies that I saw that imploded because the cost of the insurance increased and started to eat up the cash value, is because the cash value had already been pulled out in a form of a loan. You know what I'm saying? You took out, you had $20,000 in cash value. You took out a $20,000 loan. Well, if you already took out the loan and you have interest on that and you're not paying that loan back, and now you got these fees attached to it, yes, it can implode and turn into a bad situation. So
what about this? What about this then, Perry? What if I don't take out a loan? Okay, I didn't take out a loan.
Yep.
All right. But I'm not really a high income earner and I didn't get good advice. Okay. I got an IUL, right? And I'm funding it at normal rates. I'm funding it based on my policy every month, but not overfunding it.
Yep.
Will I get in trouble on my IUL?
You possibly could. And it's kind of one of those, it comes down to We would have to see the illustration and how it was purchased. And let me tell you why. When I said earlier that we could have the exact same product, Mr. Daniel, the
Yes.
exact same name from the exact same company, right? But when I had the conversation with my agent, I said to him, so here's the deal. I want the lowest death benefit you can give me here, because the purpose of this, remember, y'all, we had this conversation and started off talking about, is this a spoon or is this a fork?
Mm-hmm.
And I was like, hey, the purpose of this policy is not to have a lot of death benefit. I already got death benefit with my term over here. I'm using this policy as a asset. So I want to accelerate my cash accumulation
Mm-hmm.
and have less death benefit. Well, here's the deal. If it's structured that way, you minimize your risk of having it implode and not take care of itself, because you're forcing the cash value up because you said, I want less death benefit. So again, we had the exact same policy, exact same product, and have a different policy. Now, here's the deal. And remember, y'all, I'm an insurance agent. I wrote the IUL on myself. Here's the deal. Your agent, and I'm giving away an industry secret right here. So I'm going to piss some people off with this one here, Mr. Daniel.
Okay, here we go. Here we go.
Your agent, if you're using the policy as a asset that you can leverage that you can have capital to go out and create more passive income, if that's why you're using it, you have to hold the line with your agent and say, I want the least amount of death benefit I can get on this. But why is that important? Because the agent isn't going to sell you the least amount of death benefit, because guess how the agent gets paid? Off a death benefit. They don't get paid on your cash value, ladies and gentlemen. So if you don't know this, if you're not equipped with some understanding of how this works, where you can go in and say, so I'm getting this product for this. So instead of going and saying, hey, I need life insurance, and somebody, hey, I can sell you some life insurance, they sell you something that you don't need. You actually need to be equipped to say, I need life insurance for this purpose. So when I wrote my IUL on myself, right, and I write it for my other clients, as a vehicle that's going to help with retirement, I'm getting the least amount of death benefit that I can compliantly get without it, and still keeping it in good terms as far as being an insurance product, where it doesn't become a mech. So that's a modified endowment contract. Right. So we don't want to get into that piece. So here's the deal. These tax laws were put in place because all the wealthy folks was throwing their money into these products, right? And they're like, well, no, you still need to have some death benefit in there, because if you want to use this for tax deferment and tax-free income and all of these things, you can't just dumping money in there. We still got to keep some insurance. So there's a minimum insurance that you need to keep, right? But the deal is, your agent may not write it that way, because they don't get paid on. If you give the minimum, the smallest death benefit you can get, and they solve for that, they get paid less on that. So now you was going back to that situation of, hey, how does this happen? Well, if the IUL was written with the max death benefit, and that continues to increase kind of as you get older, because it's this renewable term that's attached to it, right? If it keeps going up and your cash value is not keeping up with it, you'll start to run into a situation where the cash value is getting eaten up to cover the death benefit. But if you got it out the gate with to saying, hey, I want the smallest death benefit I can get, and still keeping this an insurance product, so I can put that money away to grow the cash value and get tax deferred growth, and also get tax-free income or tax-free stream of cash flow in the future, then that's how it's set up. So when these implode, a lot of times they implode for one of two reasons. It wasn't set up the right way, number one, because you didn't know to say, hey, agent, I want the least amount of death benefit, because I already got term for my death benefit. I'm using this vehicle as an asset to leverage and give me tax-free income and be able to borrow against. So one, it was set up the wrong way. Two, you borrowed money and you didn't put it back. And every IUL that I've seen blown up is because the policy owner was like, ooh, I got access to capital, pulled, took out the loan and didn't pay it back, and those fees start to eat up, and the reason the thing imploded. Okay. Whew. All right, what else you got for me there, Mr. Daniel? Oh, I didn't lose you, did I? Oh, somebody asked a question right here. I'll ask them real quick. So cost more to buy. Cost more to buy versus what? Because if you're paying for something, what are you paying for? Does that make sense, right?
Right. So here's what we got. So I think what she wants to know is, does an IUL cost more
Mhm.
than whole life? And
Oh,
I know what you're getting ready to say.
yeah. So here's the deal. What are you paying for, right? So the deal is you have a versus a whole life versus a IUL. The whole life, you're getting a fixed amount, right? You're getting whatever the dividend is, that, you know what I'm saying? So you're getting that. And again, one of the companies I like is usually capped out around 6%. Well, with the indexed, because now you're investing, right, or is investing in something that mirrors the S&P 500, for example, you now had a chance to make 10, 12, 15% on it, right? So you're paying for the opportunity to make more money. So it's kind of like, hey, are stocks more expensive than a savings account? Yes, because you're paying for the opportunity to make more money. So again, everything comes at a cost. And this is where I got to make sure that we are level setting this here so we guys understand this. You need to be crystal clear on what you're paying for, right? So here's the deal. If you don't want that feature, don't pay for that feature. And I know we want to get into living benefits a little bit too, Mr. Daniel, right? But so we're on this topic here. Let's understand something. If you're in an IUL, is it fee heavy? Yes. But what are you paying for? Right? Is what you're paying for worth the fee? If it is, you pay the fee. If it's not, that's not the right product for you. So that's why, again, this has to be customized.
Oh, it is so important that you have a person that's more of a fiduciary than an insurance agent
Facts.
or salesperson.
Salesperson, correct.
Okay. You need somebody that's going to be looking out for your best interest in this thing.
Yep.
Because I'm telling you, a lot of the stuff that I'm hearing today, I'm hearing for the first time. Okay. And there's a lot of people out there, Perry, that are thinking about getting this insurance, but they don't know enough to ask the good questions.
Yep.
And that's been the problem.
And that's why I appreciate what you do, man, because the way you articulated earlier on, right? You know, that exceptional financial education piece, man, is so important, because now you kind of know some questions to ask. If you already have an insurance policy, go back to your agent and now ask these questions. Hey, is this solved for the highest death benefit or the least death benefit? Because here's the deal. If you don't tell them, hey, I want this product for this reason, and this is why I always lean into planning, right? We can hey, you got a stock? Great. Why did you get that stock? What was the purpose of that stock? Well, somebody told me I need to invest in stock. Well, you ain't got no purpose for it. I don't think you should have invested in it, right? I had that conversation with people all the time. Same way with this insurance piece. Why do you have this product? Well, I don't know. That's what they just said would be the best product for me. Well, did you tell them what you wanted the product to do? What was the purpose? Did they have that conversation? And if you don't know, and here's the deal, y'all. The onus, yes, is on you, but also too, let's flip that back onto the agent. Did the agent just try to sell you a product to make a commission, or were they asking questions to really learn, your overall financial picture? Because you're committing to put money into a product. By God, you got to understand the way the product works before you put money into it. It's so important. So it's kind of a two-way conversation here. And sometimes you may not know the questions to ask, but that's why a good advisor is going to know what questions to ask you to understand what's the right product for you.
So let me ask you this, Perry. Of all the information that we're covered here today,
Yeah.
how much aren't we covering?
Oh, we haven't even hit the tip of the iceberg. We
So
haven't talked about VULs, GULs.
So a person, the information you're giving today, can they make a good decision on which product to buy based on the information in this show?
Not yet.
Okay.
No.
Okay.
And the reason being, because we're giving information. Oh, this is great right here. Hey, y'all, and literally, just so y'all know, we don't practice this before we get on. This is that's free. This is just freestyle.
Okay.
So here's the deal. Mr. Dan, you brought up a great point. There's information.
Yes.
And then there's advice.
Okay.
We ain't giving you advice today.
All right, all right.
Provide
Let's make that abundantly clear. We're not giving insurance advice. We're
No,
giving insurance information. To give advice, you need to talk to the person one on one, don't we?
absolutely. Absolutely.
Okay.
So
All
this
right.
is not advice. We're not advising you to get an IUL or a whole life or a term. We're providing you with information so you can at least be better equipped to ask the questions, because your insurance portfolio, your insurance package has to be customized to your situation. What I got for me may not be best for you, and that's fine, right? You know what I'm saying? So that's what we're doing. This is information so you can be equipped to start asking better questions, and also too to start doing better research.
Now, somebody's asking about AG 49.
AG 40, I'm not even hip to AG 49.
Okay, so why don't you, David? Well, why don't you come into the show, man? Listen, you're putting stuff in the chat, and it's incomplete thoughts. We put the link in there for you to just come on stage here on YouTube.
Let's bring it
So
up.
yeah, let's go ahead. Let's chop it up. So I'll put it out there one more time for you.
Mhm.
All right, all right. Here it is. Here's the link. All right, it's a StreamYard link. Okay, copy it and paste it into your browser, and it works better on Chrome. Follow the instructions and come on in. So
Yep. And then I pulled it up right here. So gotcha.
Yeah.
So he's talking about an actuarial guideline. So AG 49
mhm.
now requires IUL policies to be illustrated to compute the maximum crediting rate for the illustrated scale based upon the arithmetic mean of geometric average. So you have a whole bunch of busy terms.
Mhm.
Limit the earned interest rate for a discipline scale. So here's the deal.
Yeah.
I wasn't familiar with AG 49, but I am
Mhm.
familiar with this guideline. Just didn't know it from a technical standpoint what it was
Okay.
called.
All
Here's
right.
where a lot of IULs were sold in the past. And one
Right.
of the reasons I was anti-IUL before I knew better
Mhm.
is because they would be illustrated to show that you can make 20, 30, 40% on these bad boys, right? So
Wow.
somebody is like, why? Whoa, I can get into this and
Mhm.
make, 20, 30%, 15%. Oh my gosh, you know what I'm saying? And not have the risk of actually being in the stock market and all of these other great bells and whistles. And unfortunately, they illustrated it to do this thing and outperform. And then that came back to bite a lot of people in the butts. And we talked about kind of that whole policy imploding and things of that nature, because it was illustrating that, oh yeah, you're going to get 15, 16, 20%. And when it didn't get that cash value didn't grow the way they thought it was. And that also too now is going to be impacted by the fees that's attached to it and starts to drain down on it. So it's kind of very similar to like, and this is one that blows my mind. I think this is a Dave Ramsey one. Correct me if I'm wrong here, Mr. Daniel. I think he likes to tell people that you're going to make 10% a year in the stock market. Like,
Okay.
hey, invest in this and you're going to make 10% a year in the stock market. Hey, y'all, that's setting people up for failure, because if you're basing your numbers on getting 10% a year with no ebbs and flows, no negative years, no flat years, and you're just based on a flat 10%, that's going to project out to give you more money than you're actually going to have.
Right.
So if you had planned on having $1 million based upon this 10% that Dave Ramsey said you're going to get guaranteed in the stock market, if you're projecting that out, and you get to that end road, and instead of being $1 million is really 750,000, your plan just imploded because you was based upon a number that was not going to happen, right?
Okay.
So kind of the same way. That's why I hate people speaking in generalizations.
Okay.
But
Here's another question.
Yep.
What is the best way to go about finding a good insurance advisor?
Great question. Great question. I believe you want to be good at asking questions, right? So, and not asking questions about the product, right? Asking questions about them. Hey, as you start to interview folks, well, first of all, let me take a step back. First, get some referrals. You know people who have insurance through agents. Hey, would you refer your agent? Yes, I'll refer my agent. Okay, cool. So first of all, get a referral. Second, be good at asking questions about them and their practice. Hey, do you believe in term or permanent insurance? that's gonna, if they come and say, hey, one is horrible and you should only do this, that's who I'm gonna run from, because an insurance advisor knows that there's a point of time that you need maybe both of them. Because again, what's the purpose for? Do I write term? Absolutely. Do I write whole life? Absolutely. Do I do IULs? Absolutely. And guess what? Everybody don't get the same thing, right? So if you start to ask the question, it's not even about the product, but asking them, hey, what's your thoughts on term versus permanent? Great.
Mm-hmm.
Hey, insurance agent, what kind of insurance do you have? Why do you have that? Hey, insurance agent, I was on a call. I was on a call on a Sunday morning, and I was interested in being able to use insurance as a insurance product as collateral to be able to borrow and invest in things of that nature, right? So have you ever done that before? How's that policy different from this policy, right? So you don't have to be an expert on the policy. I've been doing this 20 years. And the gentleman who jumped on here and asked about the AG guideline 49, I had to go look it up, right? Because again, there's so much to know. You're not going to know everything. So we're not telling you got to know everything about every policy. We could be on this call for a whole month and still not unpack everything about every kind of policy, right? But you got to start getting really good at what questions to ask. Hey, insurance agent, this is what I'm trying to do. What policy or policies would you recommend to get me to this goal? This is why I always tell folks, do the financial planning up front before getting any type of product. And the reason I say that, when I tell folks, hey, Perry, man, I heard you're really good at the investments, or hey, I really heard you're really dope on the insurance side with the annuities and dot. And they're like, hey, I'm going to give you some money to invest in one. I immediately put them on pause and say, absolutely not. I don't invest anybody's money. I make no recommendations on anybody's insurance or investments or planning until we sit down and do a full financial plan. And that's where you're going to actually invest and pay me to do. And they like, but Perry, man, I got this 10,000 or 20,000 I want to invest. I don't want to do a plan. I just want to invest this money with you. I would turn that business away. That's not a client I want to work with. And folks would be like, man, why? Well, why? Well, here's the deal. Financial planning is building the home. It's literally getting your financial wishes on paper. If you were building your dream home from scratch, are you going to buy the furniture day one, or are you going to go hire the architect to get the drawings of the house on paper first? Hopefully you're getting the architect. Don't be trifling and start buying furniture before you had a house. Like, imagine you and I were having a conversation and you asked me, hey, Perry, what you doing? Hey, man, I'm about to build this house. And you're like, oh my gosh, okay, cool. Where are you building? Man, I'm gonna build over in this land over here. Okay, cool. Well, what is it gonna look like? Well, I don't know what it's gonna look like yet, but I already bought the furniture. I got a comforter in here. I got my leather couch. I got my big screen TV. And you like, well, where is it gonna go in the house? Well, I don't know where it's gonna go in the house. I just, I was told that I need to get a big screen TV. And so you don't even know if that furniture even fits in the house. Unfortunately, that's most people's insurance. That's most people investments. They have no idea where it's supposed to go. So I won't advise at all until we had a house built, because after we had a house built, which means we have a plan on paper to get us from point A to point Z. After that's done, then buying the furniture is easy. So for everybody who's going to ask questions like, well, should I get an IUL? I don't know what you should get. The only thing I can tell you should get, if you don't know what investments you need to get, that tells me you don't have a plan. So you need a plan. That's one thing I can tell you need to have is a written holistic plan by a professional. So then now you know what to get. The investments, your investments, your insurance, and all of that should all be reflective of the plan. No advice should be given on buying any products or investing any monies unless you can point to, hey, my plan says I need to have this in order to reach this goal. Now I go do that thing. Okay, my bad. I went on a tangent.
That's all, man. Listen, man, you're doing your thing. I got another comment here from Serenity 2020. I got my daughter whole life. It's so much cheaper when she was young.
Absolutely. Yep, absolutely. And kudos to you. So we're having a transparency moment. Everybody knows me. If you come inside our Facebook community, can I do a quick shameless plug on the
Go,
Facebook community,
go
Mr.
right ahead. Go right ahead, man.
Hey, if this is valuable, right? I do live trainings every Thursday inside my Facebook community. Just go to facebook.com/groups/cash flow unlocked, or you can just search cash flow unlocked. It goes with my podcast as well. I do this, you know what I'm saying? Love doing it, Mr. Daniel. I do this inside our community as well. So the question was, but not even a question, it was kind of just a comment like, man, it was so much cheaper. You guess what? I dropped the ball, y'all. Transparency moment. I'm always gonna keep it 100% with you, man. Because I was anti whole life for so long, I didn't get whole life on my daughters when they were younger. Now my daughters are 14, and now I'm like, oh my gosh. Now that you know better, you do better, and I'm not so rigid in my thinking. I open up like, hey, why are people using these products? Maybe I need to understand it better, right? Versus just listening to the talking heads that say one is better than the other one, or don't do this and this is a scam, right? And now I'm like, oh my goodness, the money I could have had saved away for them at the age 14, it's now time for them to buy a car, right? I could have bought their car with the money I would have had inside their policies had I opened them up the day they were born, right? And again, when you know better, you do better. Now we have policies going on. Like literally, I can show you guys where we've already requested the illustrations from my back office, and we're going to get them those whole policies now. So what's the saying? You know, when was the best time to plant a tree? 20 years ago. When is the second best time? Today, right?
Mm-hmm.
So just take the information that you have today, y'all. So literally, kudos to you for getting that insurance policy on your daughter. And depending on how it was set up, because again, I don't know, when we say we got the whole life, I don't know how it was set up. Whole life 10 pay, 20 pay, 100 pay. I don't know any of the details to that. But more importantly, kudos to you for at least putting it in place.
Okay, so now let's get into so we're going to talk about this part and then transition into some information on living benefits. But if you get that policy on the daughter, can you get a rider that will guarantee their insurability?
Yeah. The same
What's
way
that? What is that about?
So here's the deal. You get that on the kid, and we don't know how the kid's health is going to perform. So, well, let me take a step back.
Mm-hmm.
Mr. Daniel used a term called a rider. Okay. And you guys will hear that term thrown out a lot, especially as you start to kind of dig into, life insurance and things of that nature. So let's first unpack what a rider is. All right. So the best illustration I can give you is like car insurance.
Mm-hmm.
So when you get your car insurance, right, you can ask for additional, services or attachments to that car. Hey, if my car goes in, needs to be worked on, I want to have this, agreement that I can get, a rental, and you guys are pay for the rental, right? So these are just kind of like, think of riders as add-ons, right? So you can have a base policy, and then you can start to have on these add-ons to cover different things. Those are the riders, okay? And with respects to the riders, when you start to unpack what's going on, like, hey, I'm gonna get this insurance for my kid today, you can attach a rider that says, hey, regardless of, because we don't know if this kid is going to be diabetic, going to come down with leukemia, you know what I'm saying, going to have an accident, whatever the case may be, you can purchase that rider for an additional cost. I said this earlier, y'all, there are no free lunches. For an additional cost to have that protection to where they're always you protect against insurability, right? Because we don't know what that child's health is going to look like in the future. Okay, Mr. Daniels, is that what you were kind of referring to right there? I want to make sure
Yes, exactly.
Yep. So here's the deal, y'all. Y'all can add riders. Many policies allow you to add riders for different things. One that I love is a long-term care rider. Well, Perry, what do you mean long-term care? Me as an advisor, I've never been a real big fan of long-term care insurance. It seemed really expensive and may or may not use it type deal, right? But what I did find is that we can add long-term care riders to our permanent cash value policies, right? So I have a client who has, a whole life. We have a long-term care rider for her. So she's paying a little bit extra. It's not like, oh, you're paying like an extra $1,000. It's nothing like that. I think the rider might be $25 or $30 or something along those lines. But nonetheless, she's able to now have that long-term care rider. So she's single at the point in time. She was single at the time, but and no kids. So something happened to her, that insurance policy, that rider, she could then start to use that insurance policy, to actually cover long-term care. So that's a rider. So when you ever hear the words rider, it's an add-on. You can add these riders to, again, the policy can be customized. So that's why, again, don't go buy this stuff online from somebody you don't know. You need to be sitting down, having a holistic conversation with somebody, so that if there needs to be riders on there, hey, what's important to you here? Do you need this rider? Do you need this? So the same way when you're getting car insurance, hey, do you want to add this add-on? Do you want this add-on? That's how the conversation should go with your insurance policies, right? It should be, okay, here's the base piece, but hey, do you need to add this on? Do you need this type of rider? So again, and this is a great segue kind of into the living benefits, I think, too. Mr. Daniel, what you think? Going to living benefits now?
Yes, sir. Yes, sir. Let's talk about those living benefits, because some people think about, life insurance is only good when you die.
Yeah.
Okay. Let's talk about that.
All right, cool. So I got me some notes pulled up right here just to make sure, because it's a lot to cover. And I know I'll go onto a tangent and start telling a story. So living benefits. So a lot of times we think, to your point, Mr. Daniel, life insurance is just, oh, this is what my family will get when I die. Not the case. You can have that term policy and even, permanent policy. We just say, matter of fact, any policy, if the company allows for it, different riders. So you can have, let me just go through a couple of them for you. You can have a terminal illness rider. So what is that? Hey, it may have a rider on there that, like, hey, if you have, a terminal illness, and the countdown has begun. I ran into this situation with my mom. My mom has stage 4 cancer. So for like example here, your terminal illness gives you a life expectancy of 2 years or less. That terminal illness rider can kick in, and you can start to access your death benefit today, right? So you can get access to the death benefit today to help cover bills and travel and things of that nature, going, lasting, final vacations with the family and create some memories, right? Critical illness rider, right? This can provide funds to help pay medical expenses for certain qualifying illnesses, like that have high medical costs and short life expectancies, stroke, heart attack, kidney failure, right? It's a lot of folks who have a heart attack and still live, another 10, 15, 20, 30 years, right? Now that policy that you've been paying into, you now have access to, the death benefit to help cover that. Chronic illness, right? This is like a critical illness rider, but applies if you are diagnosed with a chronic illness that prevents you from being able to complete at least 2 of 6 determined, activities of daily living, right? So again, you can have that rider in there. You got the return of premium rider. I think I mentioned at the very beginning of the show, right, that one of my first term policies was a return of premium. What's that? If I lived, I believe it's age 75, right, God willing, I get back every dime of the premium I put into the policy over that, that time frame, right? So that's a rider. You got a disability waiver premium, right? Can kick in, if you suffer from a disability. So these are all living benefits, right? And also too, the living benefits, if you have, a permanent policy, a cash value policy, to be able to borrow that money today and pull money out to supplement retirement, give you a tax-free, cash flow stream, things of that nature. Those are all benefits of today. So again, hey, Perry, I didn't even know I could put that type of rider on there. Or, hey, Perry, what I'm saying? Like, I got my policy from, this one company, and they didn't talk to me about any of that stuff. It's a combination of, we need to be more educated on what our options are, but also too, we really need to do a better job of screening the individuals that we're doing business with, and just start giving our money to people because they said, hey, this is, what you should do. Like, it's a combination of two, but that financial literacy piece is so cool. It's so important. So again, when we're sitting down with clients and we're writing, insurance as part of their holistic financial plan, we're talking about these things like, hey, client, you're currently not married, you don't have any kids, you fall ill, who gonna take care of you? Let's make sure we have this rider built into this, right? So super important stuff here. It's down. You still there? I didn't lose you.
No, I'm still here. So
All right.
listen, I'm trying to get David Drain in, but he wants to come into the stage and ask some questions. But David, you're not coming into YouTube. You're coming into StreamYard. So if it says go back to YouTube, when you click on that link, you don't want to go there. Click on where it says go to site, so you can come into StreamYard, because that's how we're broadcasting. You want to come into our StreamYard studio. That's how you get in.
Cool.
All right. So listen, Mr. John Stewart. Listen, folks, we've gone just a little bit over time, but I hope you're okay with this. Mr. John Stewart says, which is better for kids? And I think I know where you're going to go with this. Which is better for kids, IUL or whole life?
Man, it's my go-to is I'll have to see the whole plan. and I know that ain't what people want to know. They're like, no, which one do I do? And my bad, Mr. Stewart, it's gonna be, it kind of depends, right?
Yeah.
You know what I'm saying? Because which one is better for kids? Well, are we talking about a newborn? Are we talking about a 14-year-old? Are we talking about we want something fixed? Because keep in mind, as the kids, they don't own the policy. I'm the policy owner. So, why am I? So here's a play right here. Somebody may ask this question. Hey, for the kids, did you not know that you can actually become, and leverage the power of having kids to become a better banker for yourself? Because if you're doing that, well, then you may choose a whole life versus an IUL because you need a fixed amount. So it really just depends on the situation. So I wish I could give a more like, hey, this is better for kids. The answer is it depends.
All right. We have Mr. David Drain on stage here with us today. David, how are you doing today, sir?
I'm good. You can hear me?
Yes, I can hear you.
When you get old like me, you can't figure out all this new technology. Searching around trying to get on here.
Well, now you are. Now you are on. So you have a question?
Well, yeah, it was a couple of questions that when he talks about the insurance policies are being used by the banks.
Yeah.
Those particular policies have a particular name, and from what I understood, those banks are not using IULs. They're using things called BOLIs.
Correct. Bank-owned life insurance policies. Correct.
And they've been using mutual whole life policies, not just regular whole life. And those mutual policies are designed because they're using it for their pension funds, for their top executives and management. So when you talk about that, I feel that that's a little misleading because these guys are pumping millions of dollars for you to develop the cash value and the dividends and the profits that are being made. So those type of policies, that's like saying, you shouldn't fly Spirit Air or Southwest Airlines because millionaires and executives are using private Lear 1 jets. Well, heck, I can't afford a Lear 1 jet.
So
can't
David,
put that in the same category.
While you were trying to get in, you probably missed this part. We're not giving advice. We're just giving information. If you want to get good advice, it has to be a one-on-one conversation. We're not going to be able to cover. There's an ocean full of information we did not cover today.
Yeah. Well, the reason I'm saying it is,
yes,
like your guest, I was there in the very beginning when the IUL came out. And there was a lot of problems with that policy. There was a guy named Douglas Andrews who wrote a book called Misfortune. And Douglas was introducing IULs to the industry, especially in the mortgage industry for real estate, what they called equity harvesting, where guys were refinancing their homes and taking out big chunks of money and doing single premium policies, dropping $100,000, $200,000, $300,000 in those policies. And this when rates were
David, we're running out of time. Do you have a question coming here?
No, I was just saying the reason why, the information that he speaks about, that's the reason why I brought up AG 49. That was a particular reason, and AG 49 was a rule that came up because of the misinformation and the misleading of the consumers on getting IULs. not saying IUL is bad or good, but is truthfully there's more bad than there is good.
Well,
And what I'll add to that, David, and I definitely appreciate the commentary. So, couple things with respects to the conversation we're having today. We're staying very zoomed out and talking about concepts versus individual piece, but I do appreciate you kind of getting into the weeds. So that's one of the reasons I was anti-IUL for a very long time. I was anti-cash value of permanent insurance for a very long time. So this is not a conversation to, hey everybody, go get an IUL. That's not, please don't think that's the conversation. This is just a conversation of really understanding how the product works. And to your point, there has been a ton, because I've looked at a lot of IUL policies that employed it and really hurt the client. And a lot of times it came down to the client didn't know what they were invested in. They thought they had access to quote unquote free money. And also to the agent was just looking to sell a product to make a commission versus putting the client into, the right product, and also too with the misleading illustration. So we're on the same page about what you're talking about. But I do want to address what we brought up with respects to the bank-owned life insurance and things of that nature. So yes, what I'm saying, those are called the BOLIs, and I could go into a whole dissertation with that. The conversation was just to get our listeners to understand that, hey, this is how banks are using these products, cash value. And I don't believe, and I'll have to go back and look at it, if I may have misspoke and said, hey, banks are using IULs, I believe I said banks are using cash value insurance products. I don't believe I said banks are using specific IULs. If I did, I may have misspoke on that, because yes, you're using cash value with mutual companies, which is kind of one of my go-tos as well. But the idea was to just get the folks to understanding the flow of money. And this is how banks are using that to cover their expenses, infrastructure, and not just, corporate, pensions and benefit plans and things of that nature, which is still an expense on the business, which is still a concept that folks can use with their own personal finances.
Yeah.
But I do appreciate you joining.
Yeah, prior to David coming in, I think we were talking about the fact that years ago, people were anti-insurance, especially people of color, because insurance companies would take advantage and put out lies. And had to do, and the same thing had to do with banking. So we were talking about, don't be afraid of these products. You need to get educated on the products. And so that's kind of where we were going with that.
And I agree. The only thing is, you got YouTube, you got TikTok, you got Instagram. These guys are pushing, like you guys mentioned, get this insurance and you become a trillionaire overnight. And I'm like, that is utterly ridiculous, because it doesn't work that way. And you've had maybe 10, 12 people that I personally know on Clubhouse that was sold IULs on the platform, and now they regret it, because they paint a picture of serenity, when in actuality, properly structured IULs, properly structured whole life policies, or they may not even qualify for any one of those things, because they still got to maximum fund those policies for those policies to potentially do the things that they're projecting that it does. And
I'm so glad you brought that up, because that's exactly the road we're running down right now.
I love it.
Making sure people get the right information at the right time, and not give, inflated.
And I want to say something to piggyback off of Mr. Drain right here.
Go ahead.
That's something really key, properly structured. So remember, we kind of had that conversation of, we could have the same product from the same, insurance company, the same product name, but my agent or I structure mine very differently than how you structure yours. So again, y'all, the takeaway is, you don't need to know all of this. I've been into this 20 years and I still have to learn stuff. That's why we have continuing education and laws change, tax laws change, the whole nine. So you have to stay on top of this stuff. We're not expecting you as a listener right here or a consumer to be an expert. But what we do want you to do is to start to be more inquisitive, right? To start asking better questions, right? Because that's super important, because again, structured the wrong way, may totally go against what you're trying to do, and structured the right way could be a game changer for you. And the IUL, so because we had this conversation earlier on as well, I have return a premium term, I have convertible term 20. I have another convertible term 20. I have a personal IUL. My wife is being converted to a whole life with a mutual company, the same way you were talking about, Mr. Drain there. So the deal is, and that's not even including what we have on the investments and businesses and things of that nature, right? So understand that, y'all, that this is your financial future. You have to start getting more exposed to the language and the concepts, but you have to start asking better questions, right? And that's why I always lean into, before you start purchasing any of these products. And I hate to hear that people was sold IULs and bought IULs from Clubhouse, because more than likely it's a good chance that that agent or that advisor did not sit down with the client and structure it the right way. Because I can't stand the TikTok stuff and the Instagram, because my clients hit me with that all the time. Hey, Perry, I saw this on Instagram. Is this a thing? Hey, they gave you like just a table of contents, or maybe just an intro to an entire book. There's a whole lot more that goes into this piece. So that's why we're having these conversations. So, Mr.
Mr.
Drain,
Jeffrey,
I appreciate you coming on.
Mr. Jeffrey, you know what I'm saying. Penn or Lafayette, that's who you want to talk to.
Got it. No doubt. Appreciate you, brother.
All right, ladies and gentlemen, listen, we're coming up on an hour and 50 minutes. We usually stay on about 2 hours. We may go over a little bit, but can we talk about the leveraging piece and how, if we're buying an asset that is going to produce income,
Yeah.
and how we can strategically pay back the debts that we have. Now, managing your income is one thing, but let's talk about managing the debt in terms of this conversation as well.
I love it. Okay, so what we built out after 20 years, and kind of get into that point of, you know, kind of, I did a trade on this the other day. It was like entering the matrix, right? The red pill and the blue pill. Do you just want to continue to go on and just listen to the talking heads and think everything is easy and this is all you got to do? And when people say all you got to do is this, it makes me cringe, because there's nothing all you got to do is this. There's always more detail that goes into it. Or do you want to take the other pill and kind of come into this reality piece and start to see things for what it is? So, little backstory on here, and I'll make it really quick. After 20 years of being in the financial service industry and actually helping people retire, I started to look back and say, okay, how many people actually retired from their 401k and their IRAs? Because that's the line that we've been sold, is like, hey, if you want to retire, put money into your 401k. If you want to retire, have money in your IRA, right? Well, after 20 years of being in the industry and actually helping clients retire, I'm starting to realize that none of them retired off of their 401k or their IRA or a stock market investing.
Wow.
Okay. Right. And this is 20 years of case study, right? I've been doing this for a long time. So with that being said, it's like, well, how are these people retiring? Is because they all understood this concept that I'm going to share with the audience here. They understood that financial independence or financial freedom is the point in time that your passive income is greater than your monthly expenses. Okay?
Oh,
So let me say that again, y'all. When your passive income is greater than your monthly expenses. So when these folks retired, they had passive income coming in from, maybe it was a pension, maybe it was Social Security, maybe it was real estate, maybe it was the sale of a business that we then took and turned into their own private pension using an annuity play, right? But where they were able to become work optional and walk away from their jobs was not based upon what we had in the 401k. Now, a lot of those folks, you know what I'm saying, the clients I'm speaking of may have an IRA or 401k. Example right here. Helped a client retire, and they've been now retired 2 years. And the first time we've ever touched their IRA was this past week, and it's because they went to put a deck on the back of the house. But that's not what they're using for their income. So I just to level set and get all of us on the same flow, right? So we can have this conversation. So when we start talking about leverage, in order to be able to invest in things that provide passive income, we have to have capital. Okay. We have to have capital, access to cash. Well, unfortunately, if our cash is sitting in a bank account, we have this fear of, man, do I want to use my cash to go into this deal? What if it doesn't work out? What if I'm not a strong, wise or prudent investor? What if the investment is bad, right? You kind of, it's this, all this fear, because it's like, man, I'm taking money from here that I saved and worked hard for, and now I'm putting it into this investment that, I'm hoping is going to work out. Well, how we mitigate that is by having vehicles that we can grow and then be able to leverage those vehicles in order to now invest in the things that's going to give us the passive income or give us that cash flow to get us closer to financial independence. So whether we're talking about, an insurance policy, whether we're talking about, the equity in your home, running the PILL method, because again, that's an asset that's growing, and using the PILL method, you're buying that equity. So you're effectively, when you're paying down that principal, is you're buying those units of equity that you could potentially use as leverage to go out and, acquire those income producing assets. So when you start to understand this wealth hack, that wealthy folks don't grow or accumulate assets to sell them or to spend them down, which is what we've been told about our 401ks. Hey, grow your 401k to, $1 million. And then when you retire, you'll just take some of that money out to 401k every year, or that IRA every year, and cross your fingers that you don't run out of money, right? That's a lie. That's not working out very well for the majority of Americans, especially black and brown folks who are coming to the table with less assets to begin with. So anyway, that's a whole nother conversation as well. So that's the strategy we're looking for, right? And that's the strategy that we teach inside our Accelerate Academy. Is okay. You have your cash flow. That's the first pillar. Manage your cash flow. Know what's coming in, know what's going out. You know what I'm saying? You're utilizing the PILL method, and you're knocking out debt, in a very strategic way, right? Then you are taking that, some of that discretionary, and now you're accumulating an asset. What is that asset that you're accumulating? Is it your cash value policy? That's definitely an option. Is it your investment portfolio that a lot of folks don't realize you can borrow against? Is it that? Is it, hey, my business? Whatever your asset is, your home, whatever your asset is, I don't care what it is, right? Whatever that asset is, are we growing it with the understanding that we can then leverage that to get access to capital to then go out and do the things that we want to do that's going to give us the cash flow, right? So I can give multiple examples of this, how this is going down, but let me just stop for a second. What question do you have? Because I can give you guys personal examples and different strategies we've helped clients do here recently.
Okay, Perry. So let's do that. Let's take. I want to talk about how we can get that equity that you were talking about. Mm-hmm. How we can get it in that asset a lot faster and a lot cheaper.
Yep.
But there was I want to make sure get this comment by Mr. John Stewart here. Mm-hmm. And again, I know where this is going to go, but he says, if a client has a policy that is not properly structured, can they lower the death benefit to make it better?
We gotta go. It's literally how the policy was created from scratch.
Exactly.
It's how the policy was created from scratch. So to go back and be like, hey, this policy was created this way, but this is really what I wanted to do. My bad. I forgot to tell you that. That's going to be a hard hill to climb. That's a steep hill to climb. So unfortunately, you still want to always reach back out to the agent, reach back out to the insurance carrier and say, hey, this is what I would like to do. Is this even an option or anything that I can do? You might be able to exchange that policy and take the cash and exchange into something that is properly structured. But that's why it's so important that you guys ask a bunch of questions and have some baseline of understanding of how kind of these things work, so you don't get into a policy and then be a couple years down the line and be like, oh, well, I didn't know that was how it worked, or I thought it was going to do this. So unfortunately, Mr. Stewart, that's going to be a tough one, because when that policy was created, right, it was created with any riders and things that are attached to it. Can you add stuff post issue? We don't see it happen a whole lot. So again, that's definitely a conversation to have with the insurance carrier.
The idea of sunk cost, you might want to look up that term, ladies and gentlemen, sunk cost. Sometimes we can get into something, and because we've put money into it already, and we learn that we could have done maybe a little better with a different policy, because we've got so much money into this one, we're saying, now I got to start over. It might be better to start over than to keep something that's not working.
Yeah.
Okay.
That's real.
All right. So keep that in mind when you're talking to a really good financial advisor on these things. So
Hey,
let's
Don,
talk about, yes.
it's
Yes,
funny.
David.
I use that analogy on milk. If you got some milk in the refrigerator and it's spoiled, do you put it back in and say it'll be all right tomorrow?
No, you don't do that.
I like that. I'm gonna use that one. I like that one.
All right. So let's talk about I want to be able to talk about, the pill method a little bit, but I know you have some ideas around leveraging and getting these assets, and give us a couple of case studies that you're doing for some of your clients, and then I'll go into, and then at the last piece, then I'll go into how the pill method works to gain equity
Yeah.
at a lot cheaper interest cost. Okay.
Okay, gotcha. So when we think about this wealth accelerator method that we teach inside the Accelerate Academy, it's 3 pillars. And those 3 pillars are all on top of a foundation. The foundation is just getting fiscal clarity and crystal clarity around your finances and what the end goal is. So let's just level set and say, hey, the end goal is to have enough passive income coming from somewhere to cover, and it can be multiple places, coming from somewhere, streams of income coming in, passive income wise, to cover my lifestyle expense. When we hit that point, we are now financially independent. What's lovely about that is not age driven. That is not, oh, you can only do that at age 70. If you can get it done at 40, get it done. You get it done at 50, get it done. It just depends on who you are, right? So that's where we first start off, is just really getting clarity around what we're trying to accomplish. Then you have 3 pillars: cash management, systematic accumulation of cash management, number 1. Number 2, systematic accumulation of assets that you can leverage. And then number 3 is the tracking. What we're going to talk about is that second pillar, right? The accumulation of assets. So I'm just going to go right into this, Mr. Daniel, and talk about the PILL method, and then we'll be able to circle back to it. So let me show you how this flows. I manage my cash flow as an entrepreneur. I use profit first. That is the system that I utilize to manage my cash flow, right? From there, I now have access to capital and cash using the PILL method to then, the asset I'm talking about is real estate, the home we live in right now, to then, cancel that debt. So the interest cancellation, if you will, right? Real story. So I'm now putting those dollars, right, per the PILL method, paying down my principal. I now have this asset that is accumulating in value, and the principal is going down. So what's in between there is equity. I was out this past Friday looking at a commercial building for 1.2 million that I'm going to negotiate them down to probably 1.1 or 1 million that I'm going to purchase. And what am I going to be able to use as my down payment? The asset, the real estate, because of the equity I have using the PILL method. So the asset was the real estate. I was able to use that asset as collateral to get access to capital to then go out and buy, a $1.2 million project, which is going to give us about $6,000 a month in net positive income, right? If my monthly expenses are $6,000 a month, that one transaction moves me closer, if not all the way into financial independence, right? And this has happened over the course of 2 years. I think it was 2 years ago we bought the home, Mr. Daniel. We signed up for the PILL method before our first mortgage payment was even due, and that's how we've been able to move that needle, get that equity, right? So that's the play, y'all. So understand that's the play. Now we're going to run the same play with a different asset. Here recently, had a client of ours. They did a VIP day with us to understand the wealth accelerator method. We analyzed their piece, and they came to me, and their goal was, hey, we want to retire my husband in the next 5 years. And before we even got into our one-on-one meeting, we were on a Zoom call, and I was just smiling. I said, "You guys talking about 5 years? I'll have him retired in 365 days." And it's like, "Perry, are you serious?" I was like, "Yeah." They had assets. They were just wrong on the board. So we had to rearrange them on the chessboard. And what do we do? The exact same play. So we got their cash flow in order. They had some real estate. They had some equity in some real estate. We talked about how we can leverage that equity in real estate, but they also had an investment account over with a different firm. That firm never told them that they could get them a line of credit on that investment account. I did. So we moved over their investment account, which was about $350,000. And on that investment account, we got them what was called a security-based line of credit. They got that line of credit, and they went and took that line of credit and purchased not a commercial deal, but a multi-family home down, in Southern Ohio, in a historic district that is appreciating like crazy, which is giving them positive cash flow. They came back and told me that when they left my meeting, they were in tears because they could actually see how they was going to be able to retire the husband, not in 5 or 10 years, but in 365 days. So again, I ran the same play. We got their cash flow in order. They had assets. Hey, did you know that we could actually leverage this asset? Had they not met with me, they would have took that $350,000 inside that investment portfolio, and they would have put that into the property. So now everything is in that property. Using my strategy, they still had the investment portfolio, which is up. Last time I looked, probably about 25 grand since we've had it, right? Just because of the appreciation in the market, because what the stock market is doing. And then they use my line of credit to go acquire the multifamily building that they just bought. And hold on, get this, Mr. Daniel. My line of credit doesn't report to the credit bureaus. So they purchased it, and they'll still be able to do a cash out refi on that property. So again, y'all, that's how they're making money in 2 places instead of just one, right?
Wow.
Last scenario I'll give you here.
Wow.
Got another client who's, we're using the cash value from the insurance policy, right? So we're funding that. Boom, boom, boom. Money's going into that. We had a conversation one day and said, "Hey, when do you expect to retire?" She's like 20 years out. She's my age. So she's like, "Man, Perry, maybe about 20 years. I said, "Well, let's look at your numbers for a second." I said, "So your monthly expenses are about $5,000 a month." She's like, "Yeah." I said, "Okay. You got this Airbnb over here. Tell me about that." "Well, what I'm saying, we just got to rent it out, but it's netting like, $3,000. So this Airbnb is netting $3,000 a month?" She's like, "Well, yeah." "How much are your monthly expenses?" She said, "5." "Well, if your cash flow is $3,000 and your monthly expenses are 5, we only got to figure out how to make $2,000 a month." She was mind blown. She was like, "Oh, I don't have to just put a lot of money into my 401k and hope that I got No, let's cash flow. Let's cash flow our goal versus trying to save and hope we have enough money to drill down, to draw down on our goal."
Right.
So literally now, hey, where's that down payment going to come from the next property? It's going to come from the cash value insurance piece, where she's going to borrow from there for the down payment on the short-term rental, right? And be able to jump into that piece and then be able to pay her loan back, from the rentals, the rental income that she gets from there. So those are 3 examples of this play. So the asset doesn't really matter to us when we're working with clients. Everybody's going to have an asset that they're more comfortable with, whether it's real estate, whether it's business and entrepreneurship, whatever the case may be. Oh, last example, Mr. Daniel, we got to bring this one up.
Okay.
This one's kind of off people's grid. If you're a business owner listening to this, and because a lot of the business owners that we work with, I CFO for 3 different businesses, a lot of them have very little money set aside in quote unquote traditional retirement, right? Because they've gone all in on their businesses. Y'all, this is why I created this wealth accelerator method, because I'm that business owner, 40 something, 40 years old, taking a couple L's in business and stuff throughout the years. I don't see where I have a nest egg that's going to allow me to retire at my same lifestyle level, right? A lifestyle level. So again, I'm all in on my businesses. Well, guess what? You can get lines of credit on your business. If your business is cash flowing, you can go get a line of credit on your business. So that's your asset that you've grown. Right now, you can use that business to get access to a line of credit to then go invest in something that's going to give you that passive income. And I can go into a whole nother conversation with respect to what to do with the business. But for right now, I just want to give you guys, just different concepts to think about to get to financial independence. Number one, passive income has to be greater than monthly expenses. Number two, how am I going to have access to capital in order to get there? Right. And now you know that, hey, if you can get your head wrapped around that, I have accounts or there are different strategies where I can make money in two places at one time, still make money on my investment portfolio and use somebody else's money to buy real estate, still continue to gain interest inside my cash value and over this piece, or use the real estate where it's appreciating. I'm using the PILL method to increase my equity spread. So now I can use that equity to go out and purchase, $1 million deal or whatever the case may be. It's the same play. All we're doing is just swapping in and out what the asset is.
Wow,
all right, that's
Perry.
what I got, my friend.
Wow, Perry. Listen, Bev, we're going to put that link back in the chat here on how people could get a hold of you. Listen, so there it is. There is the link. Copy it and paste it into your browser, and you can set up an appointment to get some consultation at zero cost because you are here listening to this today. All right.
And let me add this too, Mr. Daniel.
Go ahead.
And if you're like, man, Perry, I don't think I'm ready yet. Regardless if you think you're ready yet or you just want to kind of fill me out some more, please join our free Facebook community. I love educating inside of that. Just go to facebook.com/groups/cash flow unlocked. Come in, kick the tires, ask questions, get more clarity.
Go ahead and put that in the private chat.
Okay.
And in the private comments. And then I will, as I'm doing this next piece, I will then post it for everybody. Listen, ladies. So here's what we're talking about. We're getting these assets now. Let's say we got the asset now, and it's cash flowing money, and people are focused on the cash flow, right, Perry? Yeah, they're focusing on the cash flow. And instead of focusing on the cash flow, let's see how we can get that other piece you were talking about and increase our equity faster. Okay. So, all right. So I've got the link here. I'm going to copy the link, and I'm going to go back and put it in the comment section. There we go. And that is the link for the Facebook group, ladies and gentlemen. But let's bring this on stage here. I'm going to put this here. This is a $520,000 mortgage, okay? And we're going to take a look at what we can do to increase our equity at a much cheaper cost, all right? So in terms of this loan at 7%, the payment is $3,459.57. And folks, if you're here on Clubhouse and you want to see this, you're definitely going to have to come over to YouTube to see it. Okay. So $520,000. Now, how much interest does the bank want on that? They want $725,000 in interest, $725,445.20, which means the bank wants you to pay $1,245,445 for your $520,000 home. Is that what you want to do? Okay. So let's break it down and see what's going on. When you make that payment, that first payment of $3,459.57, what's happening with that? $426 of that money is going to principal. In other words, creating equity. That's the difference between how much you owe on your loan and how much the house is worth. This is potential equity, depending on, what market conditions are doing. But guess what you have to pay to get that? $3,033.33 in interest to get this equity. So how much of that money is going to principal? Only $426.24. What happens next month? Because this was applied to how much you owe, you now owe $519,573.76 on line 1 of your amortization schedule. Now the bank uses this number to determine how much interest you pay on line 2. It's a little bit less, $3,030.85, and the difference goes over to the principal side. So now you've got $428.72 that went to principal. Now, I need you to watch this. And this is what the banks don't want you to know. They're not teaching this even to their employees. What happens when you want to accelerate equity growth? And what happens to the interest cost at that point? Here's a couple of examples. Let's make this first payment in January, and we can take a look and see what our February principal payment would be, is $428.72. So here is what I'm recommending. This is just teaching how a mortgage works. We're not teaching the PILL method here. We're just showing you the basics of it, okay? PILL method is way more complicated, and we don't have time to do all of that today, but watch this part. If you make your mortgage payment here in January, let's just say you know how much principal you would pay in February, and you decided you wanted to pay that principal up front. You wanted to pay that in January. You wanted to give the bank an additional $428.72 in principal in January. Well, that would mean the bank would have to subtract this $426.24. They would also have to subtract the $428.72, which brings you down here to line 2 on your amortization schedule, where you owe $519.145. That means your next mortgage payment is on line 3 of your amortization schedule, right here, where you're paying $431.22 and $3,028.35. What just happened here? For $428.72, you just eliminated line 2 from your amortization schedule. You just saved yourself $3,030.85 in interest you'll never have to pay. And you've got this equity, not for $3,000 in interest, you got it for free. You got the equity for free. If you had waited till February, you giving them this money, you would have to pay $3,030.85 to get it. Okay? So let me accelerate this just a little bit more, because Perry, you see it and I see it. We see people and that are if you want to jump in, don't forget that you are on mute, sir. Okay, so you see it and I see it. When you meet one of your new clients, and some of them have 50, 70, 100, $200,000 sitting in a bank account making 1/10 of 1%. Okay. So I'm just saying, folks, if they have this mortgage, here's what we could do. They have this mortgage. Let's take a look at cumulative principal and cumulative interest. How much does it cost to pay your loan down from point A, where you owe $520,000, and how much does it cost to pay off 1 year worth of principal, where you're paid down to right here? All the principal payments are $5,282.16. Correct? Okay. How much interest does it cost to pay off 1 year on your loan? It costs $36,232.68 to pay your loan down by $5,282.16. Let me show you just a little bit of math, everybody. Can I do that? So if I know that I'm going to pay out $5,282.16 in the first year just to pay down the loan, and it's going to cost me 36 grand to pay it down to this point. Well, what if I decided I want to take some of that money I have sitting in the bank that's making 0.1%. Let's say it's a total of $5,282.16. Let me put a calculator on the screen. So we're going to do that. Okay. We have $520,000. Then we're going to subtract, because we're going to pay all of this principal in 1 month, on the first month, $5,282.16. Okay. So we're going to subtract $5,282.16 equals $514,717.84. That's exactly what we have here on line 12. So are you saying, yes, I am saying, I could take that $5,282, pay it in month 1, and be paid down to here in just 1 month? How much interest did I just save? Okay.
Ooh.
How much? Go ahead, Perry. What do you got?
Did you save $36,232 $36,232.68 in interest?
Well, not exactly.
Okay.
Because I did have to pay interest on the first line. Yeah, I have to give. So what it did cost me, it didn't cost me $36,000 to pay it down to here. It cost me $3,033.33 to pay it down to there. Okay. So here's what we're talking about. How much does it cost to get your equity acquisition? I'm acquiring equity. If I do it the bank's way, it's going to cost me 36 grand to do it. If I do it what Perry and I are doing, making sure that we can get that equity for a lot cheaper, it's like $33,227 cheaper to pay it from point A to point B.
This is so powerful. So, ladies and gentlemen, as you listen to this, and I know you know when I first saw this. Well, first when I first read the book, so first thing I did is I grabbed the book, The P.I.L.L Method, and I was mind blown because I understood math. Oddly enough, I'm a math major. My degree is in math with a minor in biology, right? But I've never seen the math this way. So when I read the book and reached out to Mr. Daniel, connected, and we went through this process here, we were mind blown by this concept. Okay. And literally, we had just purchased our home. Before we had ever made a payment on the mortgage, we were implementing the P.I.L.L method, right?
So let me make this point, because there are a lot. I've talked to folks in the past that says, well, Don, well, if you're going to save that $33,000, then that's over 30 years. You're going to save that $33,000. No, that is not over 30 years. Let me put it to you this way. Okay. I pay somebody to mow my lawn. All right. I pay somebody to mow my lawn, and they mow it 9 months out of the year. They mow it 9 months out of the year. So the guy comes by and he says, Don, if you will pay me 6 months up front, okay, if you will pay me 6 months up front, I will credit you for 9, and I'll mow you for 9 months. Okay. So I pay him 6 months up front, and I'm going to save 3 months. Okay. Now here's my question. When I pay him up front, when I pay him in month 1, have I saved 3 months at that time? The answer is no. If he goes out of business, I haven't saved a doggone thing. In fact, I've lost money. Okay. So when do I realize my 3 months worth of savings? I have to stay in the contract for 12 months. And then I save the 3 months. So if I pay this $5,200 up front, when do I realize the savings? In 30 years? Or do I realize it in 12 months?
Ooh.
I realize it in 12 months, not 30 years. And to prove that, I've paid down to 514,717.84. Okay. Let's put it into a new amortization schedule. 514,717.74 at the same interest rate, at the same payment amount. How many payments do I have left, ladies and gentlemen? 348 payments. All right, I got 348 payments left versus 360, but I'm going to give them this money in 1 month and be paid down to here. And now here's my new calculation. So how much interest is the difference in 12 months? Well, the amount of total interest that the bank wanted from the original amortization schedule is let's clear this out. 725,445.20. That's how much interest they want now. Once I pay that down and I make that lump sum payment on month 1, well, they can't charge me all of that interest now, can they, Perry?
No, sir.
No.
No,
Well,
sir.
look at the new amortization schedule. Oh, now I owe $689,000 to $1,252. Okay, so let's see here. Let me subtract the 689,212. So we're going to subtract that. 689,212.52. Interest savings, 36,000.
Ha.
232.68. See, ladies and gentlemen, here's what we're talking about. With every month you're paying on this loan, it costs you a ton of interest to pay on this loan. So if I stay in the loan for more than 1 year, I will realize over $30,000 in interest savings because I gave the bank that money up front. I don't care what anybody says. This is the kind of savings you get. And if you want to do the ROI on it, here's what the ROI is. Okay. So, and you can Google ROI, Google it. So here's what we're talking about. I'm going to prepay $5,282.16. My interest savings is $33,227.51. So how do we figure that out? So we take what our gains are. Now, there's 2 ways to make profit. Basically 2 ways. You can increase your what you're charging people to increase profits, or you can lower your expenses. That also increases profits.
Absolutely.
So what we're doing is lowering our expenses to borrowing the money. We're lowering the expenses to borrow the money. So if I'm gaining $33,000 in interest, I do not have to pay. That's 33,227.51. I divide it by what I prepaid, divided by 5282.16 equals, and then I multiply that by 100. That's a 629% return on your money. Folks, why do you have money sitting in the bank making 0.1% when you could put it on the mortgage and do something like this and get a 300 to 600% return on your money, depending on what your mortgage is and how much money you're working with? Folks, listen, Perry, go over one more time how they can get a hold of you, because we're getting ready to shut it down for today. And then I'll tell them how they can get a hold of us here at the PILL Method.
Absolutely, y'all. So here's the deal, y'all, with this math. I gotta say this. Me, just when we looked at this piece and calculated the ROI, this was a no-brainer for us. So being able to use the PILL method in conjunction with our wealth accelerator method and how we track our passive income has been a game changer for us. So as a walking case study and walking kind of testament to the program, because of the PILL method, coupled with the wealth accelerator method, I'll be work optional before my 50th birthday. I'm 47. I turned 48 this year. So I will be work optional. The math tells me I'm going to be work optional. So it's not a wish and a prayer. It's not just really understanding the numbers and the mathematics, right? So just always thankful to Mr. Daniel for doing what you do and educating us. All right. With that being said, you're probably like, man, P, you covered a lot. And I have a ton of questions. One, please just come to our Facebook community. It's completely free. In there, you can ask questions. You can get on the calendar when you're ready to get on the calendar. As soon as you get welcome to the group, somebody on our team is going to welcome you. You're going to get an inbox from somebody on the team saying what you need. And you can just simply say, hey, was on a call with Don Daniel on the PILL method. I want to talk about my insurance, right? So best, most efficient way to do that, if you're not ready to schedule an appointment right now, is just simply go to www.facebook.com/groups/cash flow unlocked. You can subscribe to our podcast, which is under the same name, Cash Flow Unlocked, and just come into the community, because here's the deal. With respects to your finance, it should be a very personalized experience, right? And inside the group, what we're going to help you navigate is understanding and getting exposed to concepts that you weren't familiar with, you never heard of, but also two, giving you a community to tap into of like-minded individuals who are all trying to close this wealth gap, right? So come into the group, facebook.com/groups cash flow unlocked, subscribe to the podcast. And as soon as you get into the group, you'll have direct access to me and my team where you can ask questions and get on the calendar.
All right, ladies and gentlemen. So listen, just one last thing, because people ask this all the time. So Don, if I pay this $5,000 up front, does that mean I don't have a mortgage payment for an entire year? No, it does not. What it does mean is if you do this up front, that means your next mortgage payment is on line 13 of your amortization schedule. This is your new number 2 payment, not this one way up here. This is the power of prepayment. This is the power of knowing what your money can do for you. And this, when we talk about this next week, okay, this is going to be the basis of talking about what we're of our Friday show next week. Let me put it up here. Friday show next week, slavery by another name. Slavery by another name. The way lending is practiced today is literally slavery by another name, but we've gotten so used to it, we don't even realize that we're slaves. Next week, we're going to tell you the truth about how all of this works. So that's Friday's show. This coming Wednesday show is going to be Open Your Own Bank. How to become your own bank. We're going to talk about that on Wednesday. That's going to be a replay. And next Sunday's show, Flame Newton is going to be back in the studio next Sunday. Next Sunday, Flame Newton is going to be here, and he's going to talk about how to put $150,000 into your pocket, how to walk into a bank and how to walk out with $150,000 in business credit. That's next Sunday. You want to be here. And Perry, you know, yes, if you want to be here, you know you can. So
I appreciate the standing invite. I definitely want to tap into Friday, and depending on kind of how the day is going, I would love to jump on in there and participate and hang out with you and Flame, man. Just so thankful for the opportunity to share and just love what you're doing. Just keep.
All right, folks, if you want to get a hold of me, learn more about the PILL method, go to ice10k.com, ice10k.com, and let me put a new banner on the screen to crawl across the bottom there. And let's put this one on. All right, go to ice10k.com and then get a savings and earnings report. Scroll down underneath Dr. Eric Thomas's picture and click on this button that says get a savings and earnings report. And so you can start your track to financial independence right here with the PILL method and with Perry Jeffries and managing your wealth, getting the truth about how wealth is actually created in this country so that you can do what we're supposed to do, put together a program where we can give our children's children a leg up in this society. I'm telling you, folks, it can be done. It will be done. And we need your help in getting the information out there. So if you want a free savings report to know the month, day, and year you could be debt free and how much interest you can save, and take that interest savings and invest it in your families, then start right here. Go to ice10k.com. Also, don't forget to get my book. Perry talked about reading my book. So you definitely want to make sure we talk about getting the book. It's been a #1 bestseller on Amazon at least 6 times. So don't forget that. Let me put a picture of that on the screen here. There you go. All right. The PILL method, a better way to eliminate debt. Make sure you get the book. Click on that link in ice10k.com. And then the last thing we want to share with you is this. All right. I need your help. There are people out there that may not know about the PILL method and our YouTube channel. I need your help in getting the message out. So if you will go to ice10k.com and click on become an affiliate, then we can pay you anywhere from $300 to $3,000 a month sharing this information. You share this information with individuals, watch the videos, you call them back in a couple of days and say, do you want more information? They say yes, send us the information. And when they become a client, we'll pay you. Okay. I need your help in getting this information out to the masses. It's about time we learn the truth about how debt is run in this country and how we can eliminate all of our debt in an average of 7 to 9 years because of interest cancellation techniques and our technology that is second to none in the world. Our AI-powered, cloud-based computing platform, the Opportunity Cost Calculator, and our superior financial education. So, folks, that's it for this week. So, Perry, I want to thank you very much. David, thank you for coming in and asking some questions. And, folks, listen, everyone here is open to ask questions. And I've got another comment. All right, John Stewart said he's ordering the book. Thank you so much, Mr. John Stewart, for saying that you're ordering the book, and congratulations to you. So, folks, that's it. We've got one last video that we're going to play, and that's it for today. So be back here on Wednesday at 7 a.m. Central, 8 a.m. Eastern, on Friday at the same time, 7 a.m. Central, 8 a.m. Eastern, and next Sunday again, 8:30 a.m. Central, 9:30 Eastern. Listen, you don't want to miss Flame and talking about getting that financial, that business credit. And don't miss next Friday's show, Slavery by Another Name. We're going to break it all the way down. You don't want to miss that. So let's go ahead and share this last video before we go. I'm running the whole show today, so it's taking me a little longer to click on the buttons here, but we got it under control. Let's see here. This is what we want to play. Let's see here. Where's my video? There it is. All right, folks, we're getting out of here. See you in the coming days. And Perry, thank you again. David, thank you. And we'll see you next week, everybody. Bye-bye.
Peace.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
How many want to know how to pay off all of your debt in an average of 7 to 9 years? You can do all of this without refinancing, without change to your budget, without sacrificing lifestyle.
Me and my husband do the PILL method, and last year we were able to pay down $33,000 on our mortgage without feeling like we were poor. We still did tons of entertaining things and enjoyed our family.
You don't have to eat beans and rice every day. You don't have to cut up your credit cards. You don't have to drive a 30-year-old car. You don't have to sell pizzas at night to pay off your mortgage. All you need to do is pay the bank less interest. That's what we're talking about today. Here is what PILL method stands for: prepayment of principal, isolation of principal amounts, leverage, and liquidity. You understand it? You have a way of getting out of debt more efficiently. The interest rate you're quoted is not the interest rate you pay. You think you're buying a $500,000 home. The true cost of that home is what? $758,000. Total interest paid as a percentage of principal, 51.777%. That's what's going on with this loan. The ability to read and defeat an amortization schedule is not taught at any level of financial education. I need you to understand the power of a penny. You will not hear what I'm talking about from Dave Ramsey. Do you know why? Because I own the copyright. I literally wrote the book.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the PILL method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.